Hi there. Thank you for logging in early for the session. Much appreciated. Let's give a few more minutes for others to join in before we start the session. Okay? Thank you. Dear students, we're starting in about 3 minutes time. Take to your lecture. Hello, good morning. Can you guys hear me loud and clear? If yes, just type in yes in the chat box. Great. Thank you so much. All right. I think we are good to start now. It's 10 a.m. right now. A very good morning, ladies and gentlemen. Welcome on board to the Give It All Your Effort final exam preparation for paper advanced taxation Malaysia. My name is Joanne, the manager learning support for ACCA Malaysia. And accompanying me in today's session is my colleague Raymond. Okay, before I even introduce him, already turn on the camera. That's
Hello,
quick.
everyone.
That's Raymond that you see right now. And the following person that I'm going to introduce is our speaker today, Ms. Kok Fong Hun. It is a privilege to have Ms. Kok with us this very morning. I'm sure she is no stranger to many of you here. However, for those who don't know her, Ms. Kok is an experienced lecturer from Sunway Test, our platinum approved learning partner, and she has taught Malaysian taxation for 25 years. Okay, that's very long, 25 years. And of course, she is a fellow member of the ACCA. And before her teaching, she has worked in the tax department of Ernst & Young. And she has produced many prize winners under her teaching and guidance. So she will be sharing her expertise of this paper with you all in a short while. Okay. Now, before I hand over the session to Ms. Kok, we open up for questions throughout the session. Now, if you have any questions for Ms. Kok during the session, please, send them through in the Q&A box, and Ms. Kok will address your question whenever possible. So feel free to ask any questions, okay? Now, we have specially organized today's session for you, and I know it's going to be an intense and comprehensive 6-hour session. So please pay full attention, and let's get started now. Okay, all the best, everyone. And Ms. Kok, over to you. Ms. Kok, you need to unmute yourself. We couldn't hear you.
Okay.
Yeah.
Thank you, Joanne. Thank you, Raymond.
Thank you.
Thanks a lot, ACCA, for allowing me to conduct this session. I'm feeling so excited to meet so many ACCA students. How many of you all here today? 400 plus. Really a very great session. Okay. Without much further ado, let us look at my notes. This is page 1. Are you ready, guys? Do you have your notes with you? If you have, please type yes in the chat box. Okay. All right. Are you able to see the screen? Okay, good. So this is actually page 1. Let us look at the methods to answer the exam question. We focus on this one. Later on, after we finish the session, then I will come back to how much time we need to spend on each question. I think it's important to know how to answer the exam questions. Let's look at method number 1 here. All right. Now, you'll find that whenever the examiner set any questions, where can we get the notes? Yes, I think Raymond will answer that question. All right, for your method number 1, you will notice that we actually you see here a company is an SME if the paid up share capital of the company at the beginning of the basis period is not more than 2.5 million. That's point number 1. Point number 2 is the gross business income is not more than 50 million. Maybe I just share the notes into the chat box. You can download it. Let me see. All right, so for those who don't have the notes, you can actually download from the chat box, right? Okay, so we continue with this. Now, what I'm trying to tell you is normally when we answer an exam question, the examiner will give you a story. So that is the story. You have a company called DAS. The examiner say it has a share capital of 1 million on 1st January total. And then the gross business income is 30 million for the YA. So the question actually asks whether the company is SME or not. If I want to get marks for this, firstly, I don't go directly and answer the question without writing about the principle, how to determine whether the company is SME or not. To determine whether the company is SME, this is the principle actually come from the part 1 of Schedule 1 of the Income Tax Act. But you do not need to quote the section number. You do not need to quote which schedule from the Income Tax Act it is from. So this one, not necessary. But in order to let the examiner know that you actually are referring to a principle from the Act, then you need to write down the principle first. No need to quote the section, but write down the principles of the section. For example, you say a company will become an SME. Point number 1, we look at the paid out share capital is not more than 2.5 million. That's point number 1, the first principle. And the second principle, the gross business income is not more than 50 million. So you're actually quoting the principle from the Act without the need to state the schedule or the section. Then the examiner gives you a story from the question. We need to plug the details from the question and apply to the principle and say, okay, since this company has got a paid up share capital of 1 million, that's point number 1. They want to look at the paid up share capital at the beginning of the basis period. So beginning of the basis period is 1st January 2021. 1 million is the principal for this, 2.5, okay? And the gross business income is 30 million. The general principle is it cannot be more than 50 million. So I plug the detail from the question to say it's only 30 million. So as a result, this company is SME. When we say SME, we must say for which YA. So it's YA 221. So if I answer the question by just giving extracting the detail from the question, without quoting the principles from the Act, I only get half mark. But if I only give principles from the Act without applying the details from the question, I will only get half mark. I will never be able to get full marks. All right. So as a result, if you want to get more marks, you need to write down your principle. You need to write down your application at the same time to get full marks. So it's not just a matter of having technical knowledge, all right? You need to know how to write in Excel. You must have the principles from the Act plus extraction of details from the question. Now, when we talk about this, then there is another method of answering it. Sometimes if you look at the exam answers, you find that the examiner like to use this method. She will clearly write the principle by extracting from the Act, and then she will apply the details from the question in a separate sentence. Now she has all the time to prepare the answers in the best method. because there's no time constraint for her. But she has to make sure the answer is the best answer. We are not able to present the best answer under the exam environment. So, in order to save time, I will always use my principle, and then I combine my details from the question together with my principle in one sentence. For example, let's say I lump up these two. In order to lump up the two, I will say, okay, straight away, I don't say a company. Straight away, I extract the name of the company from the question. It's called DAS, Sendian Bahak. If I need to repeat this name again, then I put in bracket, I call it as a short form, should be DAS, but I call it SES. Okay, it has a paid up ordinary share capital of not more than 2.5 million. That is my principle from the Act. In this case, the question say is 1 million, so I use comma. Only 1 million, I use comma to put in my application inside. At the beginning of the basis period, this is my principle from the Act. I copy down the date from the question, 1st January 2021, by using comma. I apply. So this is my principle. This is my application. So this is my principle. This is my application. And the gross business income is not more than 50 million. This is my principle. If I don't like to use comma, then I put it in bracket, application, for the YA. So DAS, sorry, this should be DAS. It's an SME for YA 221. Do you think I'll be able to get the same marks? What do you think? Do you think I'll be able to get the same marks? As the top where I have a separate sentence for principle, separate sentence for application, yes, I'll be able to get the same marks. Then which method is comfortable to you? You will use that method. But which method you think will save time? Tell me, which method you think will save time? Second method, first method? It will be second method that saves time. It will be second method that saves time. Now, I can only use this second method if the application is very direct. If the application is not direct, then I probably have to talk about the principle first. But if the application is very complicated, then I need to separately put it in separate sentences. Like sometimes it's a bit like a discursive method. Then you need to separately put it in separate sentence. If it's very direct, then you find that if you put it in a separate sentence, it's like repeating the earlier sentence of your principle from the Act. It looks so repetitive. You might as well just put it in one sentence like this, combine it up. It saves time and it's not repeating. Yeah. Unless it's very, very complicated, the application is very complicated, then you put it in separate sentence. So this needs a little bit of practice. It also enables us to earn more marks. Okay, so always remember principle and then apply the details from the question. A lot of students just give like just principle and then they ignore the details from the question. You lose a lot of marks in that case. Okay, the next one. Now you can have another method of answering where the questions don't give much details. If the questions don't give much details, then you just take the principles from the Act. That's all. It's because there's no details given in the question. Now, why? It seldom happens, but it can happen. Now we are going for December 2021 sitting. Okay, this is the first sitting that will be examinable on budget 2021. So there'll be some new sections that is brought in. And then the new sections, some of it have been discussed in the recent examiner's article. So it's a good sitting. December is always a good sitting because that's the first sitting of a new budget. And this, especially this coming December 2021, is a very good sitting because we have an updated examiner's article. Not every sitting we have an examiner's article, but this sitting we have updated examiner's article. The examiner put in some new sections which is brought in by budget 221. So whenever the examiner wants to examine a new topic, if this is the first sitting that they're examining on a new topic, then mostly we cross fingers. Most of the time, the first sitting, the question is not so tricky. So since you're going for December 221 sitting, is the correct sitting. So this is your opportunity to pass. Okay? Now, so I'm not surprised if there are questions like this in your coming sitting, because it's a new sitting, okay, for budget 221. Now, maybe method number 4, we have method number 4 where you don't need to quote any principles from the act at all. So this one, you, for example, in your question number 1, they ask you to do a tax computation to show the tax paper of 2 scenarios. Then they'll ask, what is the best scenario? What's the best option? Okay. Then in that case, you will give your recommendation based on your computation. There's nothing, no principles to refer to. You just have to give your recommendations based on your computation. So in that case, there is no need to write any principle. So not all the answers, there must be principles and then application. So you must know which method to use. Where to access the updated examiner's article is in the ACCA website. You look for the ACCA, the examiner's article section. You go and look for it. Later on, during the break, I can actually upload for you. Okay, thanks, Raymond. Thank you. I can actually upload the specific article for you during the break. Okay, so these are the methods to answer. You make sure you know the this is called writing skill. You make sure you really have the correct writing skill. So to pass exam, of course, number 1, you must have the technical knowledge. Technical knowledge means you must cover the syllabus as much as possible. Our examiner is getting, she's making her paper very well-rounded. That means in question 1, question 2, or even 3 or 4, she will try to put in as many topics as possible into one question, which means to pass a paper, you have to cover quite a lot of the syllabus. If you want to spot, then not everybody is lucky all the time. So if you spot, you're not able to, you miss certain topics, then you will not be able to pass. So we try not to spot. Anyway, we know her style now is she tried to put in as many topics as possible into the question. So this is to make sure you actually study thoroughly on the top of the syllabus. Also to make sure if you already passed, then you would have acquired all the necessary standard of the ATX paper. So when you go out and work or in your office now, if you're working, you find that after passing the ATX paper, it really helps you in your office, okay, while you're doing your tax. If you are dealing with tax in your office, it actually helps you. You improve on your technical knowledge. Now, to make it, when she tried to put in so many topics into each question, that the disadvantage is very hard to spot questions nowadays. But the advantage is if you put in many topics, then you'll find that the questions may not be so complicated. Or let's say if she put in just RA in question number 1, if you didn't study RA, you definitely fail. So she doesn't just put in RA, she put in other topics as well, RA, control transfer, and then she puts in allowance for increased export, then she put in stamp duty, she put in tax admin inside. So at least if you didn't study RA, you will not lose so many marks. That's the advantage. And if she doesn't put in just RA in one question, that means the question on RA will not be so detailed. So in a way, it's easier to pass. Okay? But you need to open up your mind. There are some students who say they cannot see, they are not able to accept so many topics in one question. Their mind will be like, they go blank, they're not able to accept it. Then you need to fine-tune your mind to be able to accept many topics in one question. Okay. Now let's now based on this, we will continue with our. I will come back to all this exam technique later on. I want to focus on the topics first. So let us move into a popular topic called RPGT. So if you actually what we are going to do today is we will cover RPGT. That's number one. Number two, we will cover incentives. These two topics always come up in exam. I cannot cover many questions, but I can. I try my best. Okay. Then number three, I will cover a tax planning question together with a quiz. The quiz questions, although they are short, these are the scenarios that I picked up from the past year. Okay. Then we will cover the those of you are very concerned about the article. Later on during the break, I will upload the article in the chat box, so don't worry so much. Now, then I will also cover the article itself. The topics in the article, I will cover it. But the topics in the article, the examiner actually covers certain topics which is not which has not been set in the past year before. So then I will not be able to do any past year questions on the article topic, but I actually set some of the questions by myself. So we look at some of the questions. Those topics that is discussed in the article which we have past year, then I will extract the past year questions and we will do those article topics. Okay. So the article topics will be in the afternoon session. Okay. Now, you heard that foreign source income is remitted is taxable now. That's in budget 222 is not in our syllabus. We have a 9 months rule for examining the topics, the new budgets. So budget 220 just hasn't even been enacted in a parliament yet, so it cannot be in our syllabus. That means, well, once it's enacted in a parliament, 9 months later, then only the examiner can examine. So we have a 9 months rule. So they can only examine 2021 budget. The first sitting is December 2021. Okay, guys. So let us now move into real property gains tax. This real property gains tax is taxable on a chargeable gain arising from disposal of a chargeable asset. So only when you dispose is subject to RPGT. If you purchase, acquire, there's no RPGT. It's imposed on chargeable gain that arise from disposal of chargeable asset. Okay, what is chargeable gain? Let's look at the next page. Now, I think it sometimes is a little bit difficult to look at the content when you print it out because you find that the font is a little bit small, plus the background color there, then it's very hard to look at the wordings. But you can actually refer back to, you just on your PDF file on your laptop and then you look at it. Now, let's look at this is page 2. Let's look at the format of the RPGT. Just now, the formula says that the scope of charge RPGT says that RPGT is imposed on chargeable gain. So it's imposed on this chargeable gain. All right. So what is chargeable gain? It's actually disposal price minus acquisition price. You see this disposal price minus this acquisition price. You get a chargeable gain. All right. So how do I arrive at this disposal price? I arrive at this disposal price by taking consideration received minus your incidental cost minus your permitted expense, which is made up of enhancement cost and your defense title costs. the item which gives us headache is always the enhancement cost. Now, so enhancement cost, for example, if I buy a piece of land here and then I build a building, when I first purchased the property, it's just a vacant land. I built a building later. So this building is called enhancement cost. Why is it called enhancement cost? Because later on when I sell, I will be selling the house together with the land. When I sell the house together with the land, my selling price will be enhanced compared to selling just the vacant land. That's why this house is called an enhancement cost. If I sell a vacant land, I bought it, it's a vacant land. If I sell, I will not get a selling price which is as high as when I build a house on the land and then I sell the house and the land later on. Now, the fact that now when my consideration received is the consideration received for both the house plus the land, so the formula would be since the consideration from the house and the land are taxable as consideration received, so my enhancement cost, the cost that I paid to incur this enhancement cost of the house, I can minus it from my consideration received to arrive at a net receipt called disposal price. So if I want to explain it from the point of view of income tax, whenever we say something that we can deduct is something that is deductible, so I am saying that, okay, this enhancement cost, when I can deduct from my consideration received, I'm claiming deduction against my consideration received. Because my consideration received will be the consideration received for the enhancement cost here as well. Now, what happens if this house, when I sell it, before I can sell it, it was actually completely destroyed. So it was actually completely destroyed at the time when I sell this property. So I have a vacant land, I built a house, but when I sell, the house destroyed. So it was destroyed here also before I sell. So which means my consideration received, I could not have received any consideration for the disposal of the house. I only received consideration for the disposal of the land. Therefore, well, the enhancement cost that I incurred, although it's destroyed, I have incurred this enhancement cost. I've incurred the construction cost on this house, and then later it was destroyed. So when I sell it, it's no longer there, so I couldn't be selling the house. But I actually incurred the cost earlier on. Can I claim deduction against this consideration received or not? Yes or no? What do you think? The answer is no. You're right, cannot. Now you can understand the rationale. Why, if the enhancement cost is no longer in the state of a house at the time of disposal, therefore, we are not able to minus this enhancement cost from the consideration received to arrive at the disposal price. Okay, it is very logical. So if the house is semi-destroyed, would the enhancement cost be included in the computation? Yes. So long the house is in the state of a house at the time when you dispose, then you are able to minus your enhancement cost from the consideration received. So if you are selling a house which is like partly destroyed, you never repaired it, so of course your consideration received will be a lower amount. So you minus the enhancement cost, okay, your disposal price will be a lower amount. But we look at another scenario. What if compensation received is for repair as a result of damage? Okay, now let's see. We have another scenario where the house is not completely destroyed. It's damaged. Okay, so this is damage. Partly damaged only. Now, so if it is partly damaged and then you repair it, I want to know whether my repair cost is enhancement cost or not. So the house is definitely enhancement cost. So when I repair a partly damaged house, will this repair be an enhancement cost or not? Whatever is deductible under income tax will not be deductible anymore under RPGT. Whatever that is taxable under Income Tax Act will not be taxable anymore under RPGT. So if we repair, is this a revenue expenditure or is this a capital expenditure? Is this a revenue expenditure or capital expenditure? Yes, it's a revenue expenditure. Why? Because there is no improvement. You're just bringing it back to the condition, to the old condition of the house. There's no improvement, so it is a revenue expenditure. As a result, it will be deductible under Income Tax Act. If it is deductible under Income Tax Act, can I claim this repair as enhancement cost and deduct from the consideration received or not? Yes or no? The answer is no. I cannot be claiming deduction from Income Tax Act at the same time claim deduction from the consideration received under RPGT. Then you are claiming double deduction, one time from Income Tax Act, one time from RPGT. Okay? So the enhancement cost has to be a capital expenditure incurred if you want to deduct from the consideration received. Okay, now we need to deal with consideration received. Now, if this house, I go back to my first scenario, the house is completely destroyed. So at the time when the house was sold, then the consideration received, you will not have include any consideration received for the house because the house is no longer there. But when it's completely destroyed, you receive recoveries, compensation for damage to the asset. Now, the word used in the act is for damage to the asset. They did not mention that if the asset is no longer in the state of a house at the time of disposal, then you cannot include the compensation received as a recovery. They never mentioned whether the asset should still be in existence at the time of disposal. So your compensation received, whether it's received for complete damage of the asset or for partial damage of the asset, you will still take it out as compensation received. So this is the compensation received, we will still take it out as recovery. When we take it out as recovery, we minus from the consideration paid. So as a result, your acquisition price will then goes down. If your acquisition price goes down, it means your chargeable gains go up or goes down. Your chargeable gain goes up. So indirectly, if we take out the compensation as recovery, we are actually taxing it. You agree or not? I don't have to put, let's say I don't put my compensation, I don't minus it from my consideration paid. I add to my consideration received. I will also get back my chargeable gain. But the Act doesn't allow us to do such thing because the definition of acquisition price is consideration paid and incidental cost minus my compensation received. You have to minus it from consideration paid. You cannot add to consideration received. So what I'm telling you is if I take it out as recovery, actually we're actually taxing it. So we are taxing it under RPGT. Let me see just now. So improvement, we cannot claim RPGT because it's considered as improvement and not capital in nature. PACMA, so if it is improvement, then it's actually capital in nature. Okay, if there's improvement that is capital in nature, we will not be able to claim any deduction under Income Tax Act. If we cannot claim a deduction under Income Tax Act, then we have to check whether it is an enhancement cost under RPGT. Not every capital expenditure is an enhancement cost under RPGT. Not every revenue expenditure is deductible under Income Tax Act. We still have to look at the nature of the expenditure. So whether the cost is enhancement cost or repair cost, the compensation will always be under recoveries. No, it's not like that. Let us look at it. Okay. Now, so this is for damage of the property. So this is for complete damage. Or partial damaged. Now I will look at repairs. Now, when I say repairs, that means there is no improvement. So it'll be deductible under Income Tax Act. So in order to pay for this repair, then the owner of this asset could have claimed insurance recovery, for example, or compensation received from the neighbor who partly damaged the property. So you repair it back. So this is number 2. So what I'm telling you is, if the asset is partly damaged, your cost to put it back to its condition may be a deductible expense or may not be a deductible expense. When I repair, if I repair it resulting in improvement, then under Income Tax Act, it will not be deductible. But if I repair it, there's no improvement under Income Tax Act, it will be deductible. Okay? Now, so let's say I repair this, and after repairing, I just bring it back to its existing condition. So it will be deductible under Income Tax Act. Now, in order to bear the cost of this repair, I actually receive insurance recovery. So that's number 2. This is number 1. This is number 2. I receive insurance recovery. This is received for repair. And I check the repair cost. There's no improvement. So I claim deduction under Income Tax Act. So in that case, this compensation received, will it be taxable under Income Tax Act? Will it be taxable under Income Tax Act? Yes, it will be taxable under Income Tax Act. So here the compensation received or insurance recovery will be taxable under Income Tax Act. So if it is taxable under Income Tax Act, then can we include it as recovery? Can we minus it from consideration paid to arrive at acquisition price? Can we do that or not? We cannot do that anymore. If not, then we are taxing under Income Tax Act and also taxing under RPGT. All right? Okay, let me see. What did Eric ask? If there are renovation work, it should be considered as part of the enhancement cost. If there is renovation work, so you just ask yourself, if you have renovated your building, when you sell it off, are you able to fetch a higher selling price? If you can enhance the selling price, then it is an enhancement cost. All right. Now, so let's move up one page earlier. Let's move up one page earlier. Let me shrink this down. So the exemptrix on the disposal price, the exemptrix on the disposal price, they always ask on enhancement cost. So enhancement cost, they play a trick, whether the enhancement cost is still in existence at the time of disposal. If it is, then we have to include the enhancement cost. But if it is just repairing costs only, that means bring the condition of the asset back to its old condition. So it's a revenue expenditure. Deductible under Income Tax Act, then this enhancement cost we cannot include the repair costs because it's already deductible under Income Tax Act. Okay, now that is normally the tricks under disposal price. Now we look at the tricks under acquisition price. Under acquisition price, sometimes they will tell you there are expenses like quick rent, interest expense. The expenses for quick rent and interest expense, is it deductible under Income Tax Act? Is it deductible under Income Tax Act, and deductible against which income? Tell me, deductible against which income? Yes, it's deductible against rental income. So this is deductible against rental income. So since it's deductible against rental income, can I include it as incidental cost and add it to the consideration paid? I cannot add it anymore. If not, I'm claiming deduction under Income Tax Act. I'm also claiming deduction under RPGT. So I cannot claim deduction under both Act. Okay, so the next thing is recoveries. So when it comes to recoveries, we include compensation for entire destruction of the enhancement costs. Okay, entire or partial, we will also include it. All right. The recoveries, we have to exclude those compensation received for repairs because repairs is deductible under Income Tax Act. Therefore, the compensation would be taxable under Income Tax Act. Sometimes the repairs result in improvement, so it will not be deductible under Income Tax Act. Therefore, then the compensation will go into RPGT. So not all the time the compensation that you receive for partial disposal will be taxable under Income Tax Act. It can still be included as recovery under RPGT if you are not getting a deduction for the repair costs under Income Tax Act. Okay, so now based on this principle, we will do the following question, a modified exam question for you to learn up the principle. First part of the question, compute the RPGT liability. So this is a computational question. There's nothing for you to write in theory, okay? Nothing to explain, just computation. So the examiner asks you to compute, you compute. Examiner asks you to explain, then you cannot compute, you need to explain. So you're supposed to put 0 for any, in the question for where there is no tax adjustment made. Now, you must remember your CBE platform. If you put nil, the CBE platform will not be able to do the summation for you. Then there will be an error message. So as a result, now you find that all the new partial question, they don't ask you to put nil anymore. You need to put 0. Okay. Now, so you're supposed to do the tax com on the second piece of the land. Let's look at the second piece of the land. This is the second piece of the land. It was acquired for 800,000. This will be consideration paid. So there is an additional 30,000, which is legal fee, stamp duty. This legal fee and stamp duty is incurred when you sign the sales and purchase agreement. So what is this 30,000? What is this 30,000? Let me know. What is the 30,000? Yes, it's incidental cost. Very good. So this will be my incidental cost. So in order to find my acquisition price, is consideration paid at incidental cost minus recovery. So this is my incidental cost. Now HSB also incurred 120,000 on roads and drainage. And then they incur 200,000 on raising the river embankment. At first, what did they buy? They bought a piece of land without roads and drainage. They bought a piece of land without river embankment. So With these roads and drainage and river embankment, when they sell off the land, will these two expenditure enhance the value of the disposal price? Yes or no? Will it enhance the value of the disposal price? Yes. So what do I call this? What do I call the 120,000? And what do I call the river embankment? Yes, I call this enhancement cost. And I call this 200,000 another enhancement cost. Enhancement cost, I don't put it under my acquisition price. I will put it under my disposal price. That is my consideration received. Consideration received, I will minus my incidental cost, minus my enhancement cost, plus my defense title cost. These two minus. These two will be called permitted expense. So I will then minus it from my consideration received. Good. So now let's continue. Unfortunately, the embankment was completely washed away. So this embankment 120,000 was completely washed away. So at the time of disposal, will the river embankment still be in existence at the time of disposal? Yes or no? No, it will not be in existence anymore. So if it is not in existence anymore, so can I include it as enhancement cost? Can I include it as enhancement cost? No. So it has to be zero here. All right. Okay. But what about these roads and drainage? Is it still in existence at the time of disposal? Is it still in existence at the time of disposal? Yes, it is still in existence at the time of disposal. So these roads and drainage, I have to take up 120,000 as enhancement cost. So as a result, you look at the answer. You look at the answer. So my roads and drainage is still in existence at the time of disposal. Therefore, I need to put 120,000 here. My river embankment is already no longer in existence at the time of disposal, so I cannot take it in. Do I put nil or I put zero? Do I put nil or put zero? Yes, you must make it a habit to put zero. Okay. Now, so we settle this part. Let us now look at the question again. Now we are at compensation. So we have insurance compensation of 165,000. It was received for this loss. Now, this is which loss? This loss is actually for the river embankment. So the river embankment was no longer in existence, totally destroyed, and you receive insurance compensation. Can I take this in as my recovery or not? Can I take it in as my recovery? Yes. This is a capital compensation, capital receipt. So I would have a recovery of 165,000. So let's look at my answer. I would have a recovery of 165,000. That's for my embankment. So this insurance compensation is actually for this item. All right. Now we continue on. The roads were flooded frequently during the raining season, so the roads need to be resurfaced and repaired at a cost of 50,000. So this 50,000, is it enhancement cost? Is it enhancement cost? No, it's not enhancement cost. You know where the roads you need to resurface it. The surface of the road gets spoiled easily. The pothole will always arise. Okay, so then we need to resurface it, and then fill up all the potholes. So this is just a normal maintenance cost. This is to bring the conditions of the road to its existing condition only. There is no improvement. So this will be a revenue expenditure. It will be deductible under Income Tax Act. Can I treat as incidental? Can I treat as enhancement costs? No, I don't treat as enhancement costs. So my enhancement cost here will be 0 for this 50,000. So I put 0 for enhancement cost here. All right, let's continue. Then in order to pay for the repairs, the company actually received insurance compensation of 40,000 received for this purpose. What purpose? For the purpose of repairing. Now, if this revenue expenditure of 50,000 is deductible, so when you claim deduction, and in order to pay for this repair cost, you get 40,000, of which 50,000 is deductible. Then is this 40,000 taxable or not? Will it be taxable? You claim deduction before, then it will be taxable. All right, this is based on the principle from the Income Tax Act. So this becomes taxable under Income Tax Act. So as a result, this figure will not be recovery. So my recovery will become 0. Let's look at our answer. As a result, the recovery will become 0 here. This is for repairs, which is deductible. So the insurance compensation is taxable under Income Tax Act. So if you have an exam question where they tell you they have compensation received of a certain amount, but they don't tell you how they're going to use the compensation received. So what do? Do we treat as recovery, or we treat as not recovery and put 0? The question is silent. So what do we do if the question is silent? Do we treat as recovery? Yes, we treat as recovery. If the question is silent, because we do not treat it as recovery only if the recovery has been used to incur on an expenses which is deductible under Income Tax Act. So if they don't tell us how the recovery has been used, we treat as a capital receipt, not taxable under Income Tax Act. Okay, so this is the basic you should know. Okay, let's read the question again. We continue on. Now, the owner of the adjoining land, that means the neighbor, they claim that part of the second piece of land actually belonged to them, and the dispute was brought to court. But even though it's brought to court, they settled it out of court. So 28th of November 2020, there was a verbal agreement settled between the neighbor and the company, and the neighbor is willing to pay 1.5 million to buy this second piece of the land. So how they settle? They settle by, the HSB sell the whole piece of land to the neighbor. So what is this 1.5 million? What is this 1.5 million? What is the 1.5 million? Yes, it's actually consideration receipt. This is consideration receipt. So as a result, now you look at my column, I will have a consideration receipt of 1.5 million. All right. Now, we continue on. Now, subsequently, the company transferred this land to the neighbor on this date. And in defending the title to the land, because they were fighting over the land, HSB incurred legal fee of 75,000. Now, I will have 2 legal fees being incurred. one legal fee is actually incurred when you sign the sales and purchase agreement. Now, the legal fee that you incur to prepare the sales and purchase agreement are called what? They fall into incidental costs. They fall into incidental costs. Depending on your legal fee incurred, is it incurred to prepare the sales and purchase agreement to acquire the asset, then it will go into incidental costs of the consideration paid. Now, if the legal fee is incurred to prepare the sales and purchase agreement to dispose the asset, then the legal fee will be incidental cost for consideration received. So we need to know what is the purpose of the legal fee. What is it incurred for? Now we see a legal fee of 75,000 here. This legal fee is not to prepare the sales and purchase agreement. This legal fee is to defend title. If the legal fee is to defend title, then I will put it as what? Permitted expense. I will put it as permitted expense. Defend title. Okay, is put here. I will put it here. Permitted expense. That is the fee to defend title. Okay. So let's then look at here. Here I actually highlight what are the normal possible tricks of the exam questions. So one of it is disposal price. This defend title cost. Some of you may not be able to identify. The defend title cost is actually legal fee. That is legal fee to defend title, not to prepare the SPA. The sales and purchase agreement. So whenever the exam questions talk about a legal fee, you need to be a little bit careful on that. Okay, it's not a big issue. It's not something difficult. It's just that maybe you are a little bit careless sometimes. Okay, so be aware of it. Can we go back to our question? So let's look at our answer now. We have included certain items. So we will have our legal fee here. This is defend title cost. We take up our enhancement cost plus our defend title cost. It is called permitted expense. Our minus from my consideration received, I get a disposal price. Now, and then some of you will say, you cannot remember the formula. There's a lot to memorize in ATX. Actually, ATX, there's a lot of you use common sense, you are able to remember. Let's look at this. This is my income, consideration received, my receipt. I want to find my disposal price. That is my net receipt. So in order to earn this receipt, I have to bear costs on enhancement costs, also have to bear a cost on defend title costs. These are cost, or we call it expense. There's no way for me to add cost to a receipt. It is not logical. My cost we always minus from a receipt to arrive at net receipt. So you cannot say you take consideration received at permitted expense. You are using a receipt to add a cost. These are two separate type of nature of items. I cannot have my receipt add an expense. I cannot have receipt minus expense or minus my cost to get a net receipt. Okay, the same for incidental costs. Incidental costs, I can only use my receipt to minus an incidental cost minus my permitted expense to get a net receipt. That's my disposal price. So you actually don't have to memorize, you just logic it out. But the thing is, in exam, all these things you must know by fingertips. You don't go and try to logic out whether you should minus your enhancement cost or add your enhancement cost in the exam hall. You won't have time to think about it. There's no time to think. We are in the exam hall. The paper is like a marathon paper. Okay. So I then now we continue on. So we have our consideration paid 800,000. We will have the incidental cost for consideration paid. So 800,000 plus 30,000. And then I minus my recovery, I will have my acquisition price. So my disposal price minus acquisition price, I get a chargeable gain. Now, how come acquisition my consideration paid at incidental cost? Why is it not minus? Can someone tell me how come the formula is like that? Yes, this is payment. This is also payment. So I add. I minus my recovery. This is my total payment. This is receipt. I cannot have payment add receipt. I have to minus receipt to get a net payment. So this net payment is called an acquisition price. So net receipt, so disposal price minus acquisition price, I get a chargeable gain. All right, that's how you know why you add, why you minus. Okay, Mazia asked, if consideration received less than the market value, which value should we use? And then we have to know the transaction is between what parties. If the transaction is actually between independent parties, the consideration received is less than the market value. There's a case law which mentioned that if it is between parties which are not related, the Director General has no right to impose market value on it. So, but if it is a transaction between related parties, connected persons, in RPGT, they call it connected persons. So we answer Mazia's question. If the consideration received is less than market value, which value should we use? If the transaction is between connected person, which value should we use, guys? Should we use the consideration or should we use market value? Yes, we will use market value. That is para 9. We use market value if it's between connected person. So we have to see the transaction is between which parties. Good. We then now continue on. We find that we have loss. Let's look. Go back to page number 1. We study the principle for loss. Principle for loss. Okay, this page number 1. We will have our disposal price minus acquisition price. We have a chargeable gain. Then we minus our schedule for exemption. Our schedule for exemption is only for who? Is it applicable to company? No, it's applicable only to individual. Is it applicable to individual? What about individual who are non-citizen? Non-PR? Is it still applicable? Yes, it's still applicable. Okay? Applicable. Even to non-citizen, non-PR. It's only the private residence exemption is not applicable to non-citizen, non-PR. But Schedule 4 exemption is still applicable to that. Good. So we will have our net chargeable gain after Schedule 4 exemption. We minus the loss. This loss can be a current year loss or it can be a loss brought forward. Schedule 4 exemption is not applicable to executor. Executor is not an individual. You are doing a tax comp for the estate. That means the wealth of the deceased. The person already died. The wealth of the deceased is not an individual. So we will not be able to claim Schedule 4 exemption. Okay, I'm answering Siu Ping's question. What is considered as deemed disposal? What do you mean by deemed disposal? Can you elaborate further? Are you looking at certain part of the notes where you see it? Page 6. Can I cover that later on? Okay. Now, let's look at this. So this is loss. All right. So my loss, if let's say I dispose of a property in YA 2021. So in 2021, I have another property that is making a loss after a disposal. So then I would have a current year loss. My current year loss, I can actually set off against the chargeable gain that arise from a disposal in the same YA. So it must arise. I will use the current year loss to set off chargeable gain that arise from a disposal that takes place in the same year. Okay? Now, if in the same year, my chargeable gain from the disposal of another asset, I cannot fully absorb that loss, then what happens to the loss? The excess loss I will carry forward to set off future chargeable gain from future disposal. My loss, I can always set off against chargeable gain that arise from the same YA. Not enough to cover, I carry forward, but I cannot carry backwards to set off chargeable gain from a preceding YA. Okay, but I can carry backwards to set off chargeable gain in an earlier month, which is still in the same YA. Let's look at my question, the meaning of this. Let's look at my question at page 3. Look at the question at page 3. Now, if you look at my column at page 4, I've got a chargeable gain of 640,000. After arriving, how come I'm not claiming Schedule 4 exemption? How come this column? We are not claiming Schedule 4 exemption. How come the column is not? Yep, because it's a company, so there's no Schedule 4 exemption. If it is an individual, do I claim Schedule 4 exemption first or I claim loss first? Do I claim my Schedule 4 exemption first or I claim loss first? If it is an individual, I claim Schedule 4 exemption first or claim loss first. I will claim my Schedule 4 exemption first. Then only I claim loss. Okay, so now I try to find out how many properties I have sold off earlier on, which result in a loss. Now, okay, this is the first piece of land. It was sold by Hisense on 12th of November 2018. There is an allowable loss of 188,000. Now this asset number 2 is sold off in what year? Asset number 2 it was sold off in 2020. All right. Yes, 2020. This asset number 1 is actually sold off in 2018. In 2018, there is no chargeable gain from a disposal of another asset. So therefore, in 2018, this 188,000 is carried forward to the following years. Then in all the rest of the years, there's no chargeable gain. Then when it comes to YA 2020, we find that there's a chargeable gain that arises from the second property. So can we deduct the chargeable gain of the second property by 188,000? Can, because this is a loss brought forward. All right, good. So we minus 188,000 here. All right. Now, let's look at our third property. Now, our second property, we haven't decided on the disposal price yet. So it's either 28th of November or 1st of December 2022. No matter how is the latest date, let's say it is 1st of December 2022. Okay, you find that the third property is disposed on 30th of December 2022. So this is disposed in later month. There's no limit on number of years to carry forward the loss. There's no such thing called 7 years limit. No such thing in RPGT. So this is disposed in later month. So what I mean is this is disposed on 30th of December 2020. Never mind, we fix the disposal date first. Let's look at this. Now, a second piece of the land here, it was acquired for 800,000 when the sales and purchase agreement was signed. So my acquisition date will be 12th of January 2015. How do I fix my acquisition date and disposal date? Let's look at my notes. How do I fix my page 1? Look at page 1. Now, where there is a sales and purchase agreement, my disposal date will be the date of the contract, the date of this agreement. So my acquisition date or disposal date will be the date of the agreement if there's a sales and purchase agreement. If there is no sales and purchase agreement, that means it's a verbal agreement, then how do I fix my disposal date or acquisition date? It will be the date of completion of disposal. How do I determine the date of completion of disposal? That's the date when the date of transfer of ownership of the asset, the date of full consideration is received, whichever is earlier. All right. Now, if the disposal requires approval from government or state government, we call this as conditional contract. Then in that case, the date of agreement is irrelevant. The disposal date or the acquisition date will become the date of approval from the state government or government. That's all. So if it requires approval from other parties, for example, approval from the holding company or approval from the bank to release a charge of the asset, those approval is not important. What is important is only approval from government or state government. Then the date of the sales and purchase agreement will not be important anymore. It will be replaced by the date of approval of the government. So now, just now that question, this is scenario. So this is scenario number 1 where there's sales and purchase agreement. We take the date of the agreement. There's no sales and purchase agreement. Then we have to take the earlier of the date of transfer of ownership or the full consideration receipt. Where is a conditional contract, then we take the date of approval from the government. So the state government, yes, it includes the local authority. Here, let's look at the scenario here. Let's look at here, okay, guys? Now, we want to fix the acquisition date. When is the acquisition date? The acquisition date, the second piece of land was acquired when the sales and purchase agreement was signed on 12th of December 2015. There is a sales and purchase agreement. Therefore, the date of acquisition will be the date of the sales and purchase agreement. That is rule number 1 just now we've gone through. So that will be 12th of January 2015. So the acquisition date is 12th of January 2015. All right. Now, next one. We have to fix the disposal date. So let's look at this disposal date. Now, our disposal date, the asset when it was disposed, was there any sales and purchase agreement been signed? There's no sales and purchase agreement been signed. Why no? So because they mentioned is a verbal settlement. So verbal settlement, we use rule number 2. We will take the earlier of when the asset was transferred. When was the asset being transferred? And when was the full consideration being paid? Okay, the asset was transferred on this date. Let's see, let me make it clearer. Asset was transferred on this date, 1st of December 2020. When was the whole consideration was being received? 1.5, the whole consideration received is on this date. So when is the date of disposal? The date of disposal will be the earlier of these 2 dates, which is 28th of November 2002. Good, thank you, Fatima. So it's 28th of November 2002. When we write down acquisition date, when you write down disposal date, we are actually showing our working, how to arrive at the tax rate. Okay, that when there was a very old RPGT question, the examiner was very generous. Sometimes the examiner can be very generous. We never know when, but it can happen. So she actually gave half mark for acquisition date, half mark for disposal date, and then half mark for putting the correct tax rate, another half mark. So sometimes the examiner is in a very generous mood. So we don't want to miss those situations. So as a result, now because of the question, you find that all the lecturers in KL, they will tell you, you need to write down the acquisition date or disposal date, just in case the examiner is generous again. We try to earn those marks. Okay, so we find that the disposal happens in 6 years. So the RPGT is 10%. All right, we now know that our date of disposal is 28 November 2002. Let's get back to our question. This is my disposal date. And I have a third piece of land, which is disposed in December. This second piece of land is disposed in November. And this second piece of land has got a chargeable gain. My land that is disposed in December, 1 month later, has got an allowable loss. Can I carry backwards this 10,000 allowable loss? Can I carry backwards to November and set off against November chargeable gain or not? Can or not? Why is it yes? Why is it yes? Because I'm not carrying backwards to the earlier year of assessment. I'm just carrying it backwards to an earlier month. It is still in YA 2020. So long it is still in the same YA, my loss is able to set off a chargeable gain that arises in the same YA. This is still in the same YA. So I can set off. All right. So I then will put 10,000 in my COM. So I minus 10,000 in my COM. I'll be able to arrive at my net chargeable gain. Okay, let me look at. Just now I saw somebody's question. BL. May I ask if partial consideration received date is earlier than the transfer of the ownership? We will still use the date of transfer of ownership. If I receive partial consideration, you see, if I sell off, look at my formula at page 1. Now we are talking about if there is no sales and purchase agreement. What is the disposal date? It will be the date of completion of the disposal. So we don't know what is the meaning of completion of disposal. Then the axis, it will be the earlier of the date when the transfer of the ownership, the date of transfer of ownership. In practice, that's when you transfer your title, okay? There are certain forms for you to fill up. And the date when the full consideration is received. Full consideration is received. So BL, does this answer your question? If you receive part consideration, we will not bother about part. We have to take and look at the date when the full consideration is received. In computation, is it okay to put short form like January, December, and number for months? I think it should be okay. It's quite clear, right? May I know whether you will deduct the current year loss first or loss brought forward? The Act, they never mention which one to deduct first. It's actually not important, Joanne, because under the Income Tax Act, we have to minus our current year. We have to minus our loss brought forward first in our tax com because we minus statutory income first. And then our current year loss, we will minus aggregate income. So we always minus current year loss before we minus donation. Why we need to know the sequence is because you have different tax treatment, Loss profit we minus from statutory income. Current year loss we minus from aggregate income. So we need to know the difference between our loss brought forward and our CYBL, our current year business loss for income tax act. But for RPGT, it does not really matter because whether it's loss brought forward or whether it's current year loss, we will minus from the chargeable gain after the Schedule 4 exemption. We minus from the same place. So it doesn't matter which loss we use first. If you combine the two loss, you minus from the chargeable gain after Schedule 4 exemption. After that, you still got excess loss, regardless whether the excess loss is from current year or from loss brought forward. You just carry forward to next year. There's no 7 years time limit, so there's no need to split between the two. It's actually not important. The rates will definitely be given in the exam. Must all the count be presented in spreadsheet? Okay. You don't need to present your com in spreadsheet, but let me tell you, if you don't use spreadsheet, you actually spend a lot of time. For example, let's say I have consideration received. I write short form, okay? An exam, you are not supposed to write short form. I have consideration received of 100,000. Then I minus my enhancement cost of 20,000. All right. Then I will have 80,000. Now, if my enhancement cost is actually made up of two items, let's say it's 10,000, add another 10,000. Then I need to have a formula. Let's say it's 15,000. Don't want to pay. Add another 5,000. Now, if I use my spreadsheet, I cannot use my calculator. I press this two and put 20,000 here. I need to use my formula. So I use my formula. So it will be these two combined. Now, assuming this is roads, this is embankment. Now, the examiner wants to know your working. The examiner wants to know whether you are adding, to arrive at the total enhancement cost, whether you're adding your roads and embankment to arrive at the total enhancement cost. Now, if you are using your work to do it, then you have to show your working. 15,000 at 5,000. And so it will take a lot of time. But if you are using Excel to do, let's say assuming instead of 5,000, here is 2,000. You are very careless. You put 2,000 instead of 5,000. Okay, and the examiner will look at this cell. You don't have to show your working anymore. Let's say it's more complicated than this. It's a partial disposal. So if it's partial disposal, then I actually sell off 20%. So it's 3,400. Now, if you are using work to do, then you have to type out this is 17,000. 17,000 then times 20%, then you will get 3,400. But if I'm using Excel, I just put 15,000 add 2,000. Then after that, I have my working in my cell. My working in my cell will be 15,000 add 2,000. Then the examiner put the cursor there. They're able to see, this is times 20%. So the working is already there in the cell. They will give you marks for working one. But if you are using Word to answer, they put your cursor there, you're not able to see your working, which means you need to type up the working by yourself. It takes time. So when it comes to computation, especially for question number 1, it is important that you use spreadsheet to do. The purpose of giving you spreadsheet is not just for a purpose of exam also. It's for a purpose of training you when you go out and work. Nobody will use Word to do a That only happens like during my time when I was doing tax com in my office. That time we don't even have Excel. Everybody was so used to it. It's during that time so many years ago. Now we got Excel. We got spreadsheet. So you must learn to use spreadsheet. Of course, they will expect you to use spreadsheet. But if you use Word, they cannot mark you wrong. But using spreadsheet will really give you the convenience. If you answer in Word but computation in Excel, then you need to highlight. Yes, if you answer in Word, then in your answer in Word, let's say you're doing question 2 part 3, then you put there 2 part 3, refer to spreadsheet. Okay, maybe in spreadsheet, you have a few workings. Then you name your workings in spreadsheet, working 1, W1, W2, then you just put there, refer to W1. Is it okay to show negative sign instead of can? No problem. No problem, can show negative sign. Working is something like appendix, so we do not need to paste back the working in. No need to paste back your spreadsheet to Word. No need. Can I do computation on Excel but answer on yes, can. Like I say, you need to link it in your answer in your Word. Maybe certain part, only the computational part, you will do it in a spreadsheet. The theory part, definitely you use Word is more advantage. It's more convenient because that's Word. That's why we call it Word. So when it comes to comp, you just put down the sub-question there, put there, refer to working 1 of spreadsheet. Yes. Can you answer all the question in spreadsheet? Can. No problem. Is it a need to put in? Please refer to spreadsheet. Yes, I think you should. Copy computation from Excel. Wow, no, I think you don't have to copy. Just leave it in the spreadsheet. That's the purpose giving you 2. You just put a cross-referencing statement there. Okay, this part please refer to spreadsheet. Okay, if the disposal refers to partial disposal by individual by 40%, 60% in the same year, how do we do the count? You are saying that you're saying that the disposal is initial disposal is 40%. Then after that another 60%, is it? Then you have to do 2 separate computation. Border is not done by the for the total. It's still acceptable. Yes, still acceptable. Do we need to mention? Yes, mention in a word the computation is in spreadsheet. Just give an indication. If question 1 and question 2, you need to show computation. Do we need to use different tab for each question? I think when you are in question 2, you will be given a separate spreadsheet. You will not be able to use the spreadsheet of question 1. Okay, you'll be given a separate spreadsheet, so you will not be sharing the spreadsheet of question 1. There's no borders. No borders. No borders, then no need to show borders. I'm sure they know how to know. I'm sure they can read which one is your final figure. You need to state your question number when you present your answer. Yes. Okay. That's a border function. You need to right click and do cell formatting. Okay, good. All right. So we finish this part. Let's move on. Okay, guys, it's 11:30. I think I need to give you a break. Let me give you a 15 minutes break, guys.
Sorry, Miss Kok, you need to unmute yourself.
Okay, guys, welcome back. We try to finish up this question. Otherwise, we will not be able to cover the later part of the topics in the afternoon where I'm supposed to cover the article. The article is like tips to us for this sitting. I'm not saying everything covered under the article will come out in exam, but we hope that some of the topics will come out. Maybe just one small little paragraph will come out. I'm not so sure, but we definitely need to go through the article. So I need to have your cooperation. Let me tell you when you can pose your question. You pose the question when I tell you to pose. So don't pose it as and when you like. So then I was focusing on replying your question. I cannot have enough time to finish my question. Okay, I'm a bit too slow. Let's look at this now. With reference to, can you change this to the fourth property, fourth piece of land? So we are talking about this one. That's the fourth piece of the land. Okay. Now, explain. So this one is a computational question. There's nothing for you to explain. So don't try to explain in a computational question. You don't get extra marks. You're wasting time. Just compute and move on to part B. Okay. Now here they are asking you to explain. This one you need to explain. You don't compute when I ask you to explain. Even if it is a computational question, it's actually computation, but they ask you to explain. That means you have to explain the computation out in words. Sometimes I feel ATX is like an English paper. You need to convert all the workings into words. That's all. Now, you notice that there are a few requirements here. This is requirement number 1, requirement number 2, requirement number 3. When disposal will take place? What is the disposal date? How is the disposal price be determined? What some proposal from some of the UK lecturers, they will say that it will be good if you can copy this. Put in your answer as a heading. Your answer, you just copy this and put there, so that when you answer the question, you know you need to talk about this, and this. Okay. Maybe disposal maybe is 1 mark. Disposal date maybe is like 2 marks. Disposal price is 3 marks. So if you are not able to read the requirement, you miss out one of the requirement, automatically you are then losing your marks. We don't want you to lose marks. So every time when you do a question, you try to copy, paste the requirement into your answer. Then when you answer, you refer. Have you answered this part or not? Have you answered this part? And have you answered this part? You have, then you are safely on the correct direction. If not, you may be writing out of point. So there are actually 3 requirements. Now, let's read the question. Of course, SST is an examinable topic. I'm only given 6 hours. I will not be covered so many topics. You need to read up SST by yourself. Okay. Now look at the fourth question. The fourth question, the fourth piece of land, it was acquired for 200,000. They want to ask why a disposal occurred. So HSB received 25,000 been forfeited deposit from an earlier abortive sale. So it was acquired for 200,000. This is consideration paid. So this is recovery. Now negotiation is underway to exchange this third piece of land. We need to change this to fourth piece of land for another piece of land in a foreign country. So we will have, let me draw, since the answer is here, let me draw the scenario here, okay? This is page 5. So we will have HSB dispose of the fourth piece of land. So they will get another piece of land, which is a land in a foreign country. Let's look at the market value. Now, the market value on the fourth piece of land is 480,000, where the foreign land worth 570,000. That's 480. So now the examiner actually asks, is that a disposal? You are not disposing your fourth piece of land for cash. You're actually exchanging your fourth piece of land with another land which is located in a foreign country. Is this a disposal or not? Okay, the Act never mentioned that the disposal must be for cash consideration. Okay, the definition, page 4, definition of disposal means it can be a sale, can be a transfer. So because it includes transfer of asset of a real property for another real property, that's why it's called, there is a disposal. So this is a principle, then we need to apply. How do we apply? We are saying that, sorry, this should be HSB. So HSB sold its fourth piece of land and then bought, in exchange, you will get a foreign piece of land. So you will get in exchange another piece of land. That's why we call it a disposal. You're transferring out your fourth piece of land. In return, you get a land in a foreign country. So when you transfer out your land, it is called a disposal. Regardless whether you receive cash consideration or you receive something which is non-cash. Okay. The next part of the question actually asks on disposal date. So disposal date, just now we learned already. How many ways to determine disposal date? There are three methods. One is when there is sales and purchase agreement, we follow the date of contract. Another one, there is none, then the earlier of the date of transfer, full consideration received. Another one is conditional contract. Let's read. Now, the agreement to effect the exchange will be ready for signature tomorrow. So is there a sales and purchase agreement? There is. What will be the date of the sales and purchase agreement? It should be tomorrow. So generally, tomorrow, which is the date of the sales and purchase agreement, will be the disposal date. But they require approval from the state government. The fact that they require approval from the state government, what contract do we call this? What contract do we call this? Yes, we call this a conditional contract. So when it's a conditional contract, when is the date of disposal? The date of disposal will be the date of approval. That is June 2021. So this is the tomorrow's date, which is the sales and purchase date. Sales and purchase agreement date will not be relevant anymore. All right. So let us look at how the examiner answer. It's all in theory, okay? Now, see, where a disposal require approval from the state government, then she didn't mention that this is called a conditional contract. Straight away, she said, this is the disposal date will be the date of such approval. This is just a principle. There is no application from the question yet. She didn't extract any detail from the question. So this one will probably be half mark. Now, but she did mention that although the agreement say, okay, there is supposed to be signed tomorrow, but the date of disposal will not be this date. It's not relevant anymore. That will be the date when approval is obtained from the government. Now she repeat this principle again. She then put the date down. So it's application. Okay. So are you able to see? Are you able to see whether there is a general principle application? So here is the principle, and then here is the application. If you let me answer this question, I will straight away put where a disposal require approval from the state government. This is a conditional contract. Therefore, the date of disposal is a date of such approval. Then I put i.e. June 2021. So therefore, the agreement to exchange, which will be signed tomorrow, is irrelevant. I'll just put that irrelevant. That's it. Finished. I will get the same marks. I don't need to have so many sentences. You must remember the examiner has got all the time, when they prepare the answer. They want to make it perfect. So you are going to the exam hall, you don't have such time. You don't have the luxury of having such time like the examiner. You need to have the ability to string your answer into shorter sentence, yet don't lose marks. You need to practice. Okay. Then the next part of the question. So I then if I copy paste this in my answer, okay, I copy paste this in my answer script, I will be able to check, all right, I finished this part. I finished this part. That's one more requirement, that's the disposal price. Before we study disposal price, let us move back to our note number 1, where I actually give you the principle of the disposal price. Okay, it's here. So there's definition of disposal here. They tell you disposal means sale, means conveyance, means transfer of chargeable asset. Just now our question was on transfer of chargeable asset. It's considered as a disposal. So that in our question is disposal of an asset. When you transfer an asset out, it's called disposal. In exchange for another asset, there's no cash consideration. You're exchanging another asset. So you will have HSB transferring the asset out, that is the 4th piece of land, then receive land in a foreign country. So how do I determine the disposal price of HSB? Normal rule is consideration received. But you do not receive any consideration. You receive a piece of land in a foreign country. So then it will be replaced by market value of the asset received. So we don't bother whether this land is in a foreign country. If the land is, whether it's in foreign country or whether it's in Malaysia, if it is in foreign country, then it's not a chargeable asset. It is not important that the land received by HSB is a chargeable asset under RPGT or not. What is important is this asset received by SHB must have a market value. If it has a market value, we take the market value as the disposal price of SHB. Now, if this land in a foreign country does not have a market value, which is rather impossible, because land we can always do a valuation. So that means they have received, in exchange for the 4th land, let's say they have received unlisted shares. Unlisted shares will not have market value. Then in that case, it is not possible to find the disposal price of this land. So they will find the nearest value to find the market value. That will be the market value of asset disposed. So you are disposing the 4th land. That land is a land we can do a valuation. No problem. Anytime you can do valuation. Those valuer, you ask them to do a valuation of your land. 30 years ago, they also can do a valuation. 20 years down the road, they also can do valuation. They are just very wonderful people who can do valuation at any time of any year. So if you have a land, definitely can find the market value. So if with this one, the asset received no market value, you just need to find the market value of asset disposed in order to find the disposal price of HSB. Okay? Now, so let us get back to our question, okay? What will be the disposal price? Now, does the 4th piece of the land is the market value given? Yes, the 4th piece of the land, the market value is 480,000. The foreign land is 570. So we look at the answer here. So HSB received a piece of land in foreign country in exchange for their fourth piece of land. So this land in foreign country has got a market value. If it is a market value, what is the disposal price? The disposal price will be market value of the asset received. So this is the principle, market value of asset received by the disposer. So this is the principle written by the examiner. And she also mentioned that this asset received, regardless whether it's a chargeable asset, it does not matter whether it's a chargeable asset or not. What is important is it must have market value. So what is the market value? Then instead of writing down here, okay, again, I will just put the answer here, market value of the asset by the disposer, i.e., then I put 570,000. I don't need to have this separate sentence. I save time. It is important I save time because the paper is a marathon paper. You will not be able to finish all the questions. All right. So we finish this question. Let's move on to the next question. Now, if you need any help in order to get, article or what, you just put in the chat box and then maybe Raymond will help you. So we move down to question 2. Now, Timothy is a Malaysian citizen. He owns a piece of commercial land. So Timothy bought a land costing 600,000 on 4th April 2010. So we transfer this detail to our chart here. So the consideration paid is actually 600,000. When was it been acquired? It's 4th of April 2010. Now the market value of this, this is not loan, this is land. On 1st January 2013 is 1 million. So market value is 1 million. All right, guys. Anything you can see here? This is the consideration paid by Timothy on 4th of April 2010. What is so special about this date? 4th April 2010. Can someone tell me? Can I take that 4th April 2010, 600,000 as the consideration paid? No. It's like what Carmen said. Yes. This is actually bought before 1/1/2013. So if any of the chargeable asset that is bought before 1/1/2013, you need to take the market value to replace the consideration paid. Now, does this market value as at 1/1/2013 applicable to RPC shares or not? Does it applicable to RPC shares? No, it's not applicable to RPC shares. This is only applicable to real properties. Only for individual, you're right. Company, we don't look at this date. Okay? All right. So now we will see what happens to this property. What did Timothy do to the property? Now, Timothy 2014, he constructed a warehouse for 1.2 million. Which is funded by a loan which he repaid in full. So you notice that this warehouse is before 1/1/2013 or after 1/1/2013. The warehouse is before or after. So you have got a warehouse. Warehouse is 1.2 million. What is the date that it was constructed? It's constructed in 2014. Okay, it's after. Okay, now, So my consideration paid here will be 600,000. The Timothy paid consideration of 600,000 on 4th of April 2010. But we are going to take the consideration paid replaced by market value assets 11213. This warehouse is actually enhancement cost, which is his permitted expense. Do I need to take up this warehouse or not? Will depend on whether the market value as at 11213 at the time when we value this property, which is owned by Timothy, on 11213, this market value, does it include the value of the warehouse inside? Yes or no? Has it included the value of the warehouse? No, it has not included the value of the warehouse. So that means I need to take up this value of the warehouse separately. I have to take it up as enhancement costs because this is after the market value as at 11213. All right, good. So let's carry on. Now, the interest. So this will be enhancement costs. This is the permitted expense. This will replace the consideration paid. Now, the interest expense incurred on the loan is 80,000. Interest expense, is it deductible under Income Tax Act? Is the interest expense deductible under Income Tax Act? Yes. So my interest expense will not be an incidental cost. I cannot include it in. This amount is already deductible under Income Tax Act. So my enhancement cost will become 0. Now, on 10th of May 2016, Timothy received compensation, 2.5 million from the neighbor who caused significant damage to the land until the entire warehouse has to be demolished. So this recoveries of 2.5 million, is it a capital receipt or is it a revenue receipt? In January 2017, he constructed a new warehouse for 800,000. Okay, they never mentioned whether the 800,000 is actually from the 2.5 million. I suppose it is. Then they use it to build another new warehouse building. It's not to repair the old warehouse. So is this 2.5 million a capital receipt? If it is a capital receipt, then it will not be taxable under Income Tax Act. So this is a capital receipt. And we call this a recovery. All right, good. So now let's move into our page 1 again. We study a little bit principle in page 1. We study a little bit principle in page 1, all right? Okay. So for my consideration paid, if my consideration paid is before 11213, then we need to replace it by market value as at 2013. So any incidental costs, any permitted expense that you incur before 11213 would have been taken up by the market value. So you need to disregard it. If you still take in the incidental cost permitted expense that is incurred before 11213, you still take it up in the comp. That means you double take up the amount because the figure would have been reflected by the market value. So any enhancement cost, any incidental cost you incurred after 11213, you need to take up in the comp because the market value would not have included those items in the comp. It's incurred after 11213. Okay, that's the principle you should learn for market value asset 213. Now, next one. We will have this consideration paid at incidental cost minus recovery. We have a net cost. This net cost is called an acquisition price. But what happens if this recovery is more than the consideration paid at incidental cost? What happens if I have a recovery there is more than my acquisition price, then immediately the Director General say there will be a chargeable gain. Okay, and this chargeable gain, there's no disposal of any asset, but it's just that whatever you receive, your recovery is more than consideration paid at incidental cost. Since there's no disposal, you cannot claim Schedule 4 exemption. When is it taxable? Very natural, very logical. You tax it in the year you receive your recovery. All right. Now, then, let's say your recovery received in YA 2021. You actually sell off your asset in YA 2022. When you sell off your asset in YA 2022, what will be the acquisition price? Now, imagine you pay only 100,000 for your land, and then your neighbor do something that damage a certain part of your property, and then they are so generous they pay you 300K. You'll be so happy you make a gain of 200. So in that case, what is the acquisition price? What is the net cost of your land? You paid 100. Your neighbor pay you back 300. You don't have cost one. Your land is free. In fact, you make a gain of 200,000. So what is your acquisition price of this land later on when you sell off this land? It will be 0. So the disposal price minus the acquisition price later on, it will be 0. It's taxable in a way of disposal. This one, you need to know. Is in a past year question. Whatever that come out in the past year, we need to know all the tricks. If the tricks are repeated, you should be able to identify the tricks in your exam question. I don't want to have a scenario where the tricks are repeated and yet you don't even know it's a repeated trick. If you do not know, there are other candidates in the exam hall who know. So that means you really are not up to the ATX standard yet. You need to do your past question more to understand what are the tricks and what you should learn from each question. You should know. Sometimes the tricks are repeated. Sometimes they have new tricks. But because you have done more past year question, your understanding is better than other students, even though there's new trick, you're able to apply better. So in order to pass exam, you must study your syllabus more thoroughly. Do your past year. Past year is not just one round. You need to have at least like maybe 2 rounds. Okay, it depends on you personally. If you've done your past year and yet you do not know the tricks, then you need more rounds than others. Some learn faster. Some have just after doing 1 round, they only have confidence. Actually, they don't know the tricks yet. Confidence is not important. What is important? You ask yourself honestly. Do you know all the tricks well or not? Okay. If you don't know, then go through another round. You may be good in certain topics, not so good in certain topics. So you must know which are your strong topics, which one are your weaker topics. And the weaker topics, if they always come out in exam, even though you don't like it, even though you're weak, you need to strengthen the topic that you're not so good in. Okay, so now we know the principle is like this. We apply this to our question. Our question here is, Timothy, what is the acquisition price of Timothy? The acquisition price of Timothy is actually replaced by the market value on 1st January 2013. That's 1 million. Timothy constructed a warehouse, so our consideration paid at incidental cost minus recovery. That will be my acquisition price for Timothy. So this is replaced by market value. That is 1 million. There is no incidental cost. The 1.2 million warehouse does not go into my formula of acquisition price. All right. But they receive recovery. How much is the recovery? The recovery they receive is 2.5 million. So if this is 2.5 million. This one minus this, immediately I will get an acquisition price of 0. after having this acquisition price, the revenue will not let go Timothy like that because Timothy received 2.5 million. So as a result, this 2.5 million minus 1 million, there will be a chargeable gain. The chargeable gain is 2.5 minus 1 million. How much will be taxable then? 1.5 million will be taxable. Now, when will it be taxable? Then this one is just common sense. If the revenue wants to tax it, definitely they will look at the YA that Timothy received the recovery. What is the YA that Timothy received the recovery? Is 10 of May 2016. So these will be taxable in YA 2016. All right, let's look at the answer. Now, the question asked to compute the question asked to explain. They say explain the real property gains tax implication, RPGT implications. So when it comes to RPGT implications, that means they want detailed explanation. They want you to talk about disposal price, acquisition price, then your whether your holding period, right? So your tax rate, then RPGT payable. For Timothy and Joanna, so now we are talking about Timothy now. So we will have a disposal price, compensation received to, there's no disposal price, we only have acquisition price in this case, where we will take recovery more than the consideration paid and incidental cost. That is a chargeable gain. So let us look at the answer. Now, so the land was actually acquired before 11213. So this land, we need to treat it as acquired by Timothy on 1st January 2013. So the acquisition date is not just the acquisition price replaced by market value as at 1213. Even the acquisition date will also be replaced by 112013. Okay, so the acquisition price is the market value as at 11213, 1 million. So that's the acquisition price of Timothy. Why I need to know the acquisition price? Because I need to know the chargeable gain of Timothy. So here we have compensation received. How much is the compensation received? So I have a general principle. Compensation received, we need to deduct from acquisition price. So we have already determined the acquisition price in the earlier paragraphs. So, so here I will see this is actually your principal. The land is acquired by Timothy on this date. This is my application. So this is also application. This is the application. So this is the general principle. The application is 1 million. So I can actually combine general principle and application into one sentence. Sometimes when you look at this sentence, especially this sentence, it doesn't look like there's any principle inside, but actually there is. The acquisition price is market value as at 112013. That's the principle. Instead of putting IE 1 million, you can use the word of 1 million. You can use the word comma 1 million. You can put in bracket 1 million. This is the application. So these are the few methods of putting in your application by using the word of, comma, bracket in order to earn your marks. All right. So let's look at here. What is the principle written by the examiner? The compensation received by Timothy for the damage must be deducted from the acquisition consideration. Tell me this part to this part. Is this a principle or is this a application? Is it a principle or application? Yes, this is a principle. This is a principle only. This is another principle. When the sum received exceed the acquisition price, then this excess should constitute chargeable gain at the time when he received the sum. The fact that we put in the name Timothy doesn't make it into application. You know, it's not enough, the detail. Just because you put his name is not application. This is all principle only. You get marks for principle. Principle. So then, what did the question say? The question say, wherever relevant, you're supposed to compute the disposal price, acquisition price, RPGT liability. So the unique part here is the recovery is more than my consideration paid. So I need to highlight this principle and say the excess is chargeable again. After that, I need to show it in workings because the examiner said, if there is any RPGT payable, I need to show it in working. Now, if don't have this part, let's say the examiner don't have this part. This part is not stated. Then I need to convert my whole computation. Then I need to convert it and put it into this sentence. Okay, I need to put the figure into sentence by either put comma or put off or put bracket, insert all the figure inside. Because the question asks us to compute, so I then don't need to apply my principle into here. So I would have an acquisition price of 1 million minus 2.5. That's my chargeable gain. Just now I told you what is the acquisition date of this land already also replaced by 1st January 2013. Although the actual acquisition date is 4th of April 2010, this is replaced by 1st January 2013 because my acquisition price is also replaced by market value at 1st January 2013. Okay, so this is the disposal date and RPGT is 20% in a 4th year. You notice my definition of acquisition price is consideration paid at incidental cost minus recovery. That is the definition of my acquisition price. Do I need to bring in any enhancement cost at this stage? Does the enhancement cost required to be brought into this formula at this stage? No, there is no enhancement cost. So if you bring in enhancement cost, that means you do not know what is acquisition price. You must know the definition of acquisition price. When we arrive at acquisition price for Timothy, the enhancement cost shouldn't be brought in. My enhancement cost, I'll bring it in for Timothy only when I want to find his disposal price. So the enhancement cost shouldn't be in. All right, good. Now, let's read the story some more. Now, which enhancement cost is still there? Which enhancement cost is not there? So this 1.2 million is a warehouse. This warehouse has got significant damage. So it has to be demolished, the entire warehouse. So my enhancement cost, if I need to find the disposal price or whatever, it will be 0. They actually constructed a new warehouse building. This is also another enhancement cost. This enhancement cost is not demolished. It's still in the state of a warehouse when it's disposed by Timothy. So I have to take up this enhancement cost if I want to find the disposal price of Timothy. But it's not a normal disposal. We find that Timothy actually transferred the property to his daughter called Joanna for her wedding gift on 30th of March 2017 when the market value was 1.8 million. Okay. So let us study this. The principle for this is actually para 12. Let's go back to our note 1 to study the principle for para 12. So this is para 12. Now, para 12, you have a transferor, transfer a real property to the transferee. The transferor must be a Malaysian citizen. The transferor and transferee, the relationship are husband, wife. So here, husband transfer to wife. Or parent transfer to child, so it can be parent transfer to child. Or grandparent to grandchild. So if this happen under para 12, then there will be no gain, no loss for the transferor. The transferor must be a Malaysian citizen. So no gain, no loss. Then what happens to the transferee? The transferee will inherit the transferor's acquisition price plus the transferor's permitted expense. That's the principle of para 12. So let's apply this principle to our question. So what did Timothy do with the piece of land? Now Timothy transferred the property to his daughter Joanna. So is parent to child. Number one. Timothy is actually a Malaysian citizen. Condition number two. So as a result, what happened to Timothy? Timothy will have no gain, no loss. Do I need to talk about that in the answer? Yes, because they say we are supposed to explain the RPGT on the property transaction number 1 to the 1 to 3 above for Timothy. So Timothy transferred to Joanna. We still have to talk about it. So it's no gain, no loss for Timothy. Let's look at the answer. No gain, no loss. Now, so the examiner, you see how the examiner write, again, she has got all the time. Okay, it's not like y'all in the exam hall. So she will write the principle nicely. So where a donor dispose an asset by a gift to a recipient, it will be taken to be market value. This is the normal rule. But under para 12, it will be no gain, no loss where the donor is a Malaysian citizen. The donor and the recipient are parent and child. So in this case, now she applied this all principle. She applied. So she applied. The gift is made by Timothy to Joanna in the 4th year. So the tax rate, you don't have to write the tax rate because it's no gain, no loss. So that will be no gain, no loss. That's it. Now, if I were to answer this question, I will use method number 2 to answer. That means general principle, application, all combined. How do I combine? Then immediately, I don't want to use the word donor. I use the word Timothy. Or I can use the word donor. I just put the word, I just put what? What should I put here? What should I put? IE, bracket, comma, all this can be used. I can put comma, the donor, Timothy. I can put bracket, Timothy in bracket. I can put IE, Timothy. So you should know all this technique. Disposes an asset. What type of asset? Same thing. I put comma, bracket, IE. What asset was that? A commercial property, right? Is it a commercial property? Okay. Is transfer the commercial property, so I call it commercial property. By way of gift, I keep back the word gift. To recipient, who is the recipient? I can put comma, IE, bracket, Joanna. The disposal shall be taken at market value. All right. But when the transaction will be considered as no gain, no loss, where the donor, now I don't use the donor anymore. I don't use the word donor anymore because on top I really use the word Timothy. So here I straight away say Timothy is a Malaysian citizen and Timothy and Joanna are parent and child. So it's no gain, no loss. So I finished. Instead of writing like, I don't need to repeat this anymore. You know what I mean? Okay, good. So actually, when it is no gain, no loss, normally I would say that then there is no RPGT payable. All right. Now, we continue on. I need to read the question again. You see, I keep on reading the question. It is quite impossible for you to read the question one time and you keep on writing without referring to the question again. That means you may not be answering what the examiner wants. That is a common mistake made by students. They always answer what they know. They don't answer what the examiner wants. If you don't answer what the examiner wants, automatically you lose marks. So now I will go back to the question. I think I already finished off with Timothy. Now is Joanna's time. So, Joanna, I need to explain what is her acquisition price, okay? Because she received the property from her father as a wedding gift. Did she sell off the property or not? Yes, she sold off the property. So I take care of her acquisition price first. So what is Joanna's acquisition price? She will inherit the father's acquisition price plus the father's permitted expense. What is the father's acquisition price? The father's acquisition price will be replaced by market value as at 1213. So she will receive the father's acquisition price at 1 million. She will also, now there is no recovery. Sorry, this is, I'm not filling, I did not insert at the right place. So it should be here, 1 million. She's supposed to also inherit Timothy's permitted expense. What is Timothy's permitted expense? So this 1.2 million, just now we said that it's totally destroyed. So enhancement cost will be 0. There will be another new warehouse, which is 800K. So this is a new warehouse. So I don't take in this 1.2 million because it already been destroyed. I will take in the 800,000. Okay. So sorry, just now it was here 1 million. We minus the recovery. How much was the recovery? 2.5 million. So the acquisition price is actually 0. So I am not going to inherit 1 million. I'm going to inherit 0. Add the enhancement cost, which is still in existence when it was transferred to Joanna. The enhancement cost that is already completely destroyed. So when Timothy transferred to Joanna, that first warehouse is no longer there. I cannot take in that warehouse. So we can only take in the cost of the second warehouse, which is 800,000. As a result, it will become 800,000. That's the acquisition price of Joanna. How about 1.5 million chargeable gain due to permitted expense? The 1.5 million chargeable gain, you need to pay tax, isn't it? Who has to pay tax on the 1.5 million chargeable gain? Who has to pay tax? Timothy has to pay tax. You pay tax already, solve already that problem, already pay tax. You're not going to transfer your tax to Joanna. Cannot. You can only transfer the acquisition price to Joanna. Okay, good. So now the next part of the question. Joanna then sold the property for 2.8 million. So 2.8 million minus 800,000. No problem. That will be the chargeable gain. Okay. So now is also how to determine the, we already determined the acquisition price of Joanna. We also know what is the disposal price of Joanna. This one we know for Joanna. So next one is we need to know the holding period. To know the holding period, no problem. Acquisition date is no problem. It will be the date when Timothy transferred to Joanna. That will be the acquisition date of Joanna. But what is the disposal date of Joanna? There is a sales and purchase agreement dated 14 March 2021. Do we take the sales and purchase agreement date? Normally we should, but there is a condition. they are supposed to obtain consent from the state government dated 19 May 2021. So this will be the disposal date because it's a conditional contract. Again, they expect you to talk about the disposal date. Okay, so the tricks are rather repeated, but this part is very, very unique. This part is very unique. This part is also very unique. So at the end of the day, disposal price minus acquisition price. So the acquisition price here, Joanna is an individual. Now you find that she can claim Schedule 4 exemption. The disposal date is based on the date of approval of the government. Because it's unique, so we need to explain how we arrive at this date. So RPGT is in the 5th year. 15%. All right. So we finish off this question. Now, anything you want to ask now, you can post your question into the chat box. Any question you want to ask? Saturday, you all don't have questions to ask. Okay, CBE platform, any answer type beyond A4 size will not be marked. No such thing. Chi Hong, there's no such thing. Do we need to, of course you need, RPC actually came out a little bit last, the last sitting, September sitting, but it also came out in June sitting, a little bit in June, little bit in September. It's not something in detail. The examiner does not examine in detail on RPC, so you should know the basic of RPC. Okay, if the examiner has been setting a topic like continuously, we will not let go the topic until we find the examiners stop setting on the topic, like withholding tax. She has been setting since March and then June, then September. So we cannot let go of the topic until like maybe December, she stopped setting on withholding tax, then we stop. RPC, she has started, she set a little bit in June, then September a little bit. So I don't think I want to let go RPC. It's like becoming like her favorite topic. Every sitting she set a little bit, but not in detail. The question mentioned to explain. I know the question mentioned to explain, but Erickson, you must remember here they actually ask us to compute. That's why we have computation. If there is no such sentence here, as I mentioned, then your whole computation must be converted into the explanation in a form of brackets or comma or IE. If they ask to compute, then only we open up spreadsheet. Yes, if they ask to compute, then only you open up spreadsheet. But if the computation is like 20,000 at 10,000, you don't have to open up spreadsheet for that. You can put it in your Word, in your explanation. This figure at this figure, you get that. That is very, very short computation. No need to open up spreadsheet for that. Spreadsheet is for your convenience. It's not for the examiner to fail you because you didn't use the spreadsheet. The spreadsheet is there because it's easier to compute using spreadsheet and it's faster to compute using spreadsheet. So if you find that the computation is a little bit like lengthy, you find doing it in spreadsheet easier, then you open up your spreadsheet and put a clause in your Word to ask the exam marker to refer to the spreadsheet. The detailed working is in spreadsheet. Okay, it's up to you whether you want to use Word or you want to use spreadsheet. No need to state section number, no need to state para number, no marks will be given one. No extra marks will be given. If you want to state, you have to make sure you state the correct section. You state the wrong section and then you start to explain principle of another section, they can you're not very impressive, you know, they can mark you wrong because they don't know whether you understand or not because you quote a wrong section. So you want to quote a section, you have to make sure it's a correct section. If even if you can quote a correct section, no extra mark. So why you want to quote a section? Don't quote a section. Whether you will share the recording, I am not so sure. Okay, if there is a deemed disposal by an individual, reclassification of real property from non-current asset to current asset, will the individual be entitled to Schedule 4 exemption? Non-current asset to current asset, will it be at Schedule 4 exemption? So far, I compute the Schedule 4 exemption for that. Donor is permanent resident, can apply, no gain, no loss. The question actually mentioned citizen, they didn't mention PR, it has to be a citizen. You miss out on the part of why acquisition price to Joanna is 800,000 minus Timothy. Joanna is 800,000. It's because we have Timothy transfer the asset to Joanna. Timothy is a citizen. He is a parent. He's transferred to his child. This is a gift. So this is para 12. So acquisition price of Joanna will be the acquisition price of Timothy plus Timothy's permitted expense. So Timothy's acquisition price is 0. His permitted expense is the new warehouse, 800,000. This will be the acquisition price of Joanna. That's why. Now, if the acquisition date on 1st of May 2020, the disposal date, if the acquisition, I think Eric asked me, this is the second time you asked me, right? Acquisition date, this is in the 5th year or 6th year? Oh, how come got problem? 1st of May 2020, and the disposal date is 31st March 2025. So I will end this on 1 year later is 30th of April 2021. Okay, then 1st of May 21 up to 30th of April 22, then 22 to 23, 23 to 24. Yours is what? 24 to 25. Yours is no, yours is here 25 to 26. So your date, this is 1st of May 25 to 30th of April 26. Yours happened on 31st of March. It's here. Sorry, it's here. Yeah. One, two, three, four, five. 5th year. Page 6 says that it's not a deemed disposal. Page 6. Page 6. This is not a deemed disposal. There's no disposal actually. It's just that the chargeable gain, the recovery is more than consideration paid. The property is still belong to Timothy. He didn't sell it off. So there's no disposal. That's the meaning. Is partial disposal popular? Yes, it can come up. It's quite popular. Father sell an RPC share to son. Is this no gain, no loss transaction? Yes, it's no gain, no loss. I mean, it has to be a gift. Okay, no gain, no loss. Yes. All computation round to the nearest ringgit, even tax liability, yes, it should be rounded to the nearest ringgit. If you don't want to round it to the nearest ringgit for tax liability, you want to put it to 2 decimal points, the examiner said no problem. But round it to the nearest 1 ringgit. RPGT return need to be submitted by acquirer and disposer, correct? RPGT will need imposed on the disposer. Why the acquirer has to submit return? Because it's for control purposes. If I'm an acquirer, I let's say if I want to avoid RPGT, I don't submit my RPGT return form. But if the Director General make the acquirer submit RPGT return form as acquirer, if I don't submit, I know that they will be able to cross-reference back to the return form that is submitted by the acquirer. So there's no way you can actually avoid paying RPGT. It's actually quite difficult to avoid RPGT because not just the CKHT form to be submitted by the acquirer will allow the Director General to cross-reference to, because when you dispose your property or you sign a sales and purchase agreement, you also have to pay stamp duty. So when you stamp your document to make the S&P agreement a valid agreement, you need to stamp it. When you stamp it, the Director General will know already. The Director General, Lembaga Hasil Dalam Negeri, they will know, they will get the detail cross-reference back to the stamp duty department. Also, transfer of land. You go to the land office, you transfer your property, they will also know. Okay. Can you do all question 1 and 4 in spreadsheet? Can? Recording will be shared latest by Monday. Okay. The permitted expense 800,000 is the enhancement cost for Timothy. If need to calculate the disposal price of Timothy, okay, that's a very good question. Now, the enhancement cost of Timothy, you're right. But you must remember this, Chia. You must remember if we need to calculate the disposal price of Timothy, Timothy is having no gain, no loss. No gain, no loss means disposal price will be equals to acquisition price. So that means disposal price follow acquisition price or acquisition price follow disposal price. In this case, when I say disposal price is equals to acquisition price. Which one follow which one? It means disposal price follow acquisition price. This one, disposal price follow acquisition price. All right? Disposal price follow acquisition price. You're right, Ayman. Now, so just now, what is the acquisition price of Timothy? Tell me. What is the acquisition price of Timothy? What is Timothy's acquisition price? Timothy's acquisition price is actually 0, right? The acquisition price of Timothy is 0. So my disposal price will be 0. My enhanced, that means it will replace, the acquisition price will replace all the consideration received minus the enhancement cost, minus the defense title cost, minus the incidental cost. This whole formula will be replaced by the acquisition price. So I do not use my enhancement cost anymore. My acquisition price is equals to 0. Therefore, it's no gain, no loss. If you're asking, Eric, if you're asking, it's not para 12, then yes, I will use the enhancement cost. Okay, if I use enhancement cost, if the disposer will have to take up the enhancement cost, if it is a normal disposer, not para 12, then you find the acquirer will not use enhancement cost anymore. Because now the enhancement cost, they pass it to Joanna. Joanna is using the enhancement cost. So when we find the disposal price of the disposal of Timothy, we find that enhancement cost does not go in the formula at all because the disposal price is equals to acquisition price. So the formula is very logical one. Why the acquisition date of Timothy is 4/4/2013? No, it's not 4/4/2013. It's not 4/4/2013. It's 1/1/2013. You are right, 4/4/2013. Page 7. Okay, let me see. 11213. Is 112013. Okay. Should you write? Let me see what are the question. If there's a case where the disposal was done by a company rather than joint owner, then there's no para 12 anymore. It's a normal disposal. Unless it falls under para 3B, okay? So you must know the para 3B properly also. Should you write Director General IRB? I should write Director General. It actually does not matter, but I normally write Director General. The examiner will not mark you wrong just because you write Director General or IRB, so long they understand what you're trying to refer to. If the RPC shares is gifted to the son after the company changed its status to a non-RPC company, will the son be still subject to RPGT? When it comes to RPC shares, when we have father transfer shares to the son, if we want to know whether the son is actually getting RPC shares or not, we will check the company status at the time when the son bought these shares. Is the company RPC or not? So if you're asking me, at the time the company already changed the status to become a non-RPC company. So in the hands of the father, whether the company is RPC or not, the shares will remain RPC shares because the father was owning RPC shares. Whether the company later on become non-RPC company, the shares will remain RPC shares. But when it comes to a son, when it transfer to the son is buying new shares then. So we need to check at the time when the son buy the new shares, is the company RPC or not? If the company no longer RPC, or the company is not RPC at all at the time when the son received the shares from the father, then that's not RPC shares. Okay, you will not inherit the RPC status from the father one. There's no such thing. What is rebase date for LLP? For real property, if I am talking about just now, I'm talking about RPGT. My RPGT, my land is bought before 11213. 11213, RPGT, not LLP. My land is bought before 11213. Then the asset has the acquisition price has to be replaced by market value asset 2013. That's called rebase back to 11213. Okay. The reason behind this is because our property, if it is bought, our property has got a chart like this, uptrend chart. So if I bought my property before 11213, so this is 11213. I bought it, let's say, 1997. I bought my property. The price is the Asian financial crisis. The price of the real property should have been very low. So if I sell it in 2021, if I dispose, the disposal price, assuming I bought a double-story house, 1997, maybe the double-story house is only about 100,000. When I sell it in 2021, maybe it's 1.5 million. There's such a huge difference, so the chargeable gain will be very huge. Inside this difference between the disposal price and the actual acquisition price of 100,000, there's an element of inflation inside. So it would not be fair to tax the owner or the disposer of a property on the inflationary element. So as a result, then the Director General, they come up with this rule: if you bought your asset so many years ago, you don't have to take your acquisition price, the consideration paid as the acquisition price. You will take the market value on 11213, you rebase it to market value at 11213 to be your acquisition price, so that the difference will not be so large. You are removing the inflationary element out of it. Is it for no gain, no loss? Acquisition price is always acquisition price of this acquirer is always acquisition price of disposer at permitted expense. Yes, it is always like that. That's a standard formula for the acquirer. Whenever the disposer has got no gain, no loss, then the acquirer have to inherit the acquisition price of the disposer plus permitted expense of the disposer. That is for para 12, para 3b, para 17. All this same. If you put appendix in the middle of the question, what do you mean by in the middle of the question? You are talking about if the examiner asks you to write a letter or write a report. Now, if you put your appendix in the middle of the answer, in the middle of the letter, or in the middle of the report, then it is not called an appendix. Appendix is like you use your handphone, you click attachment, like your WhatsApp, you have attachment, you attach something to your conversation. So your letter is the cover letter, your report is the cover report. So if I want to attach something, that appendix cannot go into my letter, cannot go into my report. It has to be a separate document. If it is a hard copy, then it has to be clipped together behind the cover letter, stapled together. So you cannot put your appendix inside your letter, you cannot put inside your report. Otherwise, you will lose 1 mark for appendix. Okay, do you need to write full form for Director General Matrix IRB? You have to write rightly, they will not accept short form. So in your first sentence, you write in full, Director General of Inland Revenue. Then after that, you put bracket DGIR. Then after that, the rest of your answer, you can use short form DGIR. Okay. Any more questions, guys? I think I need to pass the session back to Raymond or Joanne. We need to break for our lunch.
Yeah, thanks, Miss Kok.
Thank you.
Yeah.
Thank you, Joanne.
Yeah, guys, it's lunch break right now, so go and get yourself a nice meal. And remember to come back here at 2:30 p.m. Yeah, we will resume sharp 2:30 p.m. All right. So enjoy your lunch, guys. See you all later. Bye. Hello, everybody. Welcome back. Can you guys hear me? Very well. Thank you so much. Well, there's one student there right in Chinese character. I'm so sorry, I couldn't read that. I don't know what that means. Never mind. I hope you're feeling more energized now after a good meal. So let us now proceed with the second session for the rest of the afternoon. So let us have Miss Kok back with us right now to continue the session, Miss Kok.
Thank you, Joanne. Welcome back, everyone. Okay, let's get back to our page 1. I want to talk about the exam technique now. Okay, so altogether, we actually need to get 50 marks to pass. So what I'm telling you is you need to try to do all the 4 questions, because 4 questions will be 100 marks. You want to get 50% correct in order to pass. So if you don't do 4 questions, for example, you only do question 1 to question 3, that's only 80 marks. So you're trying to pass with trying to get 50 marks out of 80 marks. It's more difficult compared to trying to get 50 marks out of 100. So the best thing is you need to do all the 4 questions. So if you are taking a class under other lecturers, other institution, I think they also give you mock exam. Go back and take a look at your mock exam paper. Did you just do question number 1, number 2, and then you stop? That means your time management is not good. If we want to do 4 questions, we need to allocate our time for every question. So question number 1, 60 minutes, that's 1 hour. Question number 2, 45 minutes. Then question 3 and question 4 is actually 35 minutes for each question. Now, it's not just knowing the time to be allocated. You need to make sure you are disciplined enough to follow the time. Okay, question number 1, 60 minutes you hit. You need to learn how to let go, move on to the next question. Whether you finish your answer for question number 1 or not, you need to let go to question number 2. If you cannot finish, that means you've been stuck somewhere. Once you're stuck, you're not writing, you're not earning marks. So the moment you're stuck, you move on to the next part. So let's say I have question 1, and then I have part 1, part 2, part 3, and then part 4. Okay, now I can do part 1. Okay, fine. Part 1, then if part 1 is 3 marks, then I times 1.8. I make sure I spend the time within the time allocated. So
Sorry,
3 times.
Kok.
Yes.
Sorry, Miss Kok, to interrupt. Are you showing your screen?
Oh, okay.
Yeah.
Okay, so
The
sorry.
student, yeah. No problem.
Okay, let me check. Yeah, I need to share screen. Okay. But you guys could hear me just now, right? All right. Okay. So now I'm here. I'm talking about, let's say, question 1. I have 4 parts in my question number 1. So I repeat what I mentioned just now. So each question, you have to follow this time allocation, 60 marks, 45 marks, 35, 35. Then in total, you would have 20 marks, 20 minutes access. The first 5 minutes is for you to either read through the question, or you get you want to navigate around your questions. You'll take a look at the what are the topics that come up. Okay. Then after that, the 60 minutes is for question number 1. If you follow this strictly, you would have 15 minutes left at the end of the day. Now, so how do I do my question? My question, as I told you, it will be made out of many topics for question 1, part 1, part 2, part 3, part 4. Now, if the question is, most of the time, the questions are not interrelated. If it is interrelated, it's only maybe for part 1 and part 2. Then part 3 and 4 is not interrelated, which means you do not need to have the information from part 1 and part 2 to do your part 3. Is independent. So let's say you do part 1 and part 2. Part 1 you can do is 3 marks. 3 marks times 1.8. So you only spend about 5 minutes. Once you hit, you need to let go. Go to part 2. So then you will allocate your time again. There are some students who do not want to allocate so strictly according to the parts. Then you allocate 60 minutes for one whole question, but you need to do fast. So let's say you are stuck for part 2. Very difficult, very difficult. You keep on thinking, you know that if you use some time, you probably can get the answer, but you're thinking and the answer doesn't flow out. You need to let go already. If it is a bit tough, then you have to allocate your time properly. 1.8 maybe times this one is let's say is about 7 marks times 7. So if it is tough, you need to allocate your time. Don't overspend your time. Once you hit, you cannot finish also, you need to let go, because the moment you're thinking, you're not earning marks. You remember, the moment you're thinking, you're not earning marks. So if it is tough, don't need to spend time. Skip. Go to the next non-related part. Do that one. Do this one. Easy. Do first. Pocket up the marks first. Then out of the 60 minutes, you still haven't hit yet. You still have maybe about 10 minutes more to go. Then we go back to the easier part to try to finish the easier part. Don't start with the most challenging part and then go back to those parts you skipped earlier on. So when you skip in your answer, you actually need to press enter, make sure that you leave space. So when you go back, you will know straight away which part you skip. Okay, if you don't leave lines, then when you go back, you forget which part you skip. So leave lines, it does not matter. Marks will not be deducted even if you leave lines. Okay, so once you hit this 60 minutes, even if you haven't finished, you need to let go, move on to question number 2. You do the same thing for question number 2. Do the easy part first, tough one, skip, and then go back and do later. You do the same for question 3 and 4. Now, for each question, you can overspend your time by 3 minutes only. If you overspend your time by 3 minutes for each question, is 3 times 4 is 12 minutes. That means your checking time, 50 minutes minus 12, you only got 3 minutes to check. That's all. So you can see how crucial is the time. You're not supposed to overspend your time. If you overspend your time, you will be able to maybe finish 3 questions out of 4. You're trying to pass 50 out of 80 marks. Now, of course, there are many students who do only 3 questions, they pass. You cannot pass in those sittings where the 4th question is very, very tough. That means you let go question number 4, you didn't have time to do, and yet it's tough. That means you are not the only one in the exam hall. You didn't do question number 4. Those have time allocated the time properly also, they can't do question number 4 because it's very tough. And then it does not matter. You can pass by just doing 3 questions because everyone else also cannot do the 4th question. But if everyone else can do all the 4 questions, you can only do 3 questions, then you will be in trouble. So time management is very important, okay? Now, so after the time management, so firstly, you must have technical knowledge by studying your syllabus, cover your syllabus properly. Then you must have writing skill, this one, writing skill. Now, writing skill, we already gone through the whole morning on writing skill. Then after that, this one will be your preparation work. Then in the exam hall, time management will be very important. Your time management is weak. You find out that you can only do 2 questions. How to pass with 2 questions? 60 marks. Trying to get 50 out of 60. Impossible. You do the question 3 and 4 only, then you're trying to get 50 out of 40 marks. Definitely impossible. So you need to do your time management properly. Okay. So that's the basic. Then after that, those measures that you need to take when you prepare your answers will be, you need to number your question properly in your Word or spreadsheet. Also must number it properly. Okay. Now, then, as I told you, in order for us to make sure we actually write what the examiner wants, maybe you should copy the heading of the question. Copy part of the question as a heading, so that when you answer, you keep on referring to the requirements without the need to refer back to the question. Okay. Now, if you have, let's say, 5 points to present, after every point, it will be good that you leave lines. Every point, don't cram all the 5 points into one paragraph. Each point, one sentence, maybe 2 sentences. Then, in order to write your second point, you leave line so that it's easier for the marker to mark. Imagine you are the marker. If you are the marker, you'll be very tough to mark everything in one paragraph compared to those answers prepared in nicely. You have separate lines to separate the points. Subject needs to be included in the format. Farah, I cannot understand your question. Can you phrase it clearer? Now, you must know your format a letter and format a report properly. Are you asking about this format? Subject need to be included in the format. Okay. So you must, before you go in the exam hall, you must know your format of letter, format of report properly. So when it comes to report, so it to, from, date, all this basic thing you must know. Then this is the title, opening paragraph, closing paragraph. No need to sign for report. Okay. Now, if the question, actually question 1 asks like this. Question 1 is question 1, part 1, part 2, part 3, part 4. You're supposed to address all these issues in a report. Then in your report, when you put down here, when you're answering part 1, you put part 1. If the question says A1, then A2, A3, then part C, you follow the same thing. All this sub-heading here, you need to follow the marking of the sub-questions in the question. Just follow. Can you write your answer in point form? No, you cannot write your answer in point form. What do you mean by point form? Point form is like number 1, resident. Number 2, incorporated in Malaysia. That's called point form. Number 3, pioneer status. Then pioneer period from this date to this date. So it's actually, these are called point form. That means it's not complete sentence. You are supposed to write incomplete sentence. Now, even if I put my numbering on each complete sentence, sentence number 1. Let's say the name of the company, ASP. ASP is a resident company in Malaysia. That's point number 1. But I have a complete sentence. Point number 2, ASP is incorporated in Malaysia. That's my point number 2. But I have a complete sentence. The fact that I number my sentence doesn't mean it is point form. Point form means incomplete sentence. You're not allowed. So long as complete sentence, whether you put numbering 1, 2, 3, 4, or you put bullet, it is all acceptable. Okay. Now, so your appendix. So here the question normally asks, if it is question number 1, they normally ask you to do a text com. So you have to write that, okay, the text com for YA1 is presented in the attached appendix. The moment you write like that, they give you half mark. Now that means this is the main com. The main com must be an appendix. So appendix, you know how to put your main com in the appendix? That's 1 mark. All right. The format of a report is 1 mark. This is a format of the report or memorandum, same. It's just that if it is a report, you just write report 2. If it is memorandum, you write memorandum 2. Okay. Now, effective communication. The examiner sometimes gives 2 marks for this. In total, is 4 marks. So effective communication is important. We want to know whether the examiner wants to know whether the student, when they present the answer, are they presenting it in a pragmatic method, in a systematic method, the reader can understand. We don't want to have the student, the thoughts is very messy. You talk about income, then after that you talk about expenses, then you talk about income, you talk about expenses. It is all jumbled up. So it doesn't flow nicely. The person who read also get very mixed up. So we do not want that type of presentation of answer. It's not so much of your English, it's more of how you're going to present your points so that the reader can understand. Can you answer the question not in sequence? No problem. You can answer your question not in sequence. You can start with question 3. Then after that question, maybe question 3 jump to question 4, and then question 1, question 2 is okay, but you need to highlight which question you are doing. Okay. If member within the company from is the company's name, okay, that does not matter. From is maybe it is an internal memo, so is the maybe the tax director writing to the finance director. So you can just write from who, then to who, the destination from, since it's internal memo. Will you lose marks if you forget to delete the marks in bracket when you copy the requirement? I don't think they deduct. In ACCA, there is no such thing like negative marking, which means that if you do something wrong, they cannot deduct marks one. Okay, and you deal by putting the marks in brackets, putting it into your worksheet. There is no marks allocated for that. They just look at the model answer. No marks attached to an item in the model answer. Then they cannot simply give you marks. They cannot deduct marks. So the thing is, they just don't bother. Dayang, so no need to worry. Now, so next one, this is the format of the letter. Okay, date, sender. So the address, you must think of an address, 2 addresses before you go in the exam hall. Don't go in the exam hall, only start to think of that. There's no time. It's either dear sir or dear madam. If the exam question asks you to write a letter to the board of directors, do not write dear board of directors. There's no such salutation. You write dear sirs if you are supposed to write to the board of directors. And then the heading, opening paragraph, then your content. So your closing paragraph, yours sincerely, yours faithfully, it does not matter. You have to put your, if they give you a destination, you write your destination, your name rightly, you should put your name and then you sign. Okay, this is the name of the firm, your destination and name, to show that you're actually writing on behalf of the firm. Like for example, you are working for PwC, you are tax manager writing the letter on behalf of PwC. You normally have your name, your destination, then PwC at the bottom of your name to show you're representing your firm when you write this letter. Okay. So far the examiner has not come up with like a workshop to tell the students and lecturers what they actually look out for in a letter and in a report. But this is basically what they do in their past year answers, so we just follow. What date you put matters. You just put the date that you go in the exam, 8th of December, just put it there. Don't bother so much, but you must have a date. They cannot mark you wrong for putting a wrong date, but the date must be there. They don't really bother one. So we just directly copy all the requirement and paste it in the answer. No need to amend the title. You can do, if I think it will be nice if you shorten it. If it is requirement too long as a heading, then it's like very long, it doesn't look nice. In practice, you don't have such heading. It would be nice after you answer already, you shorten it. Okay, now if you have time. Now, okay, so this is the you need to take care of this. Now, so the professional marks, you have to make sure you earn your professional marks. 4 marks, if you need to earn 4 marks from doing a question, you need to have 8 points. So this 4 marks is actually like bonus marks. People give you bonus, you must take. Okay, don't say, I don't want to take these 4 marks. I rather earn the 4 marks from doing a very challenging question. These 4 marks I don't want. There's no such thing. It's easy to get the first 47 marks, but it's hard to get the last 3 marks. That means the last 3 marks to reach 50 is very hard. What can you say to the board of directors? Board of directors are right, dear sirs. That's it. Okay. Now, after that, you need to have your appendix. Your main come in appendix. But if you're talking about small computation, like maybe 70% of statutory income, you want to show that working. You mentioned that maybe RA is used to set up against 70% of statutory income, and then you want to show the working. So you show the working, you can show it in the letter when we are talking about such short working. So 70% times 100,000. 70% of standard income amounting to, let me see, 70,000. You want to show the working of this 70,000, which is 70% of 100,000. No need to show this short working in the appendix. The appendix is for the main tax com. They will tell you in the question that they ask you to compute the tax computation for a chargeable income for YA, what and what you're supposed. Maybe you're supposed to do a comparative tax com also, or ask you to compute the tax savings, all those. And then you read the question, what is the main com they want you to do? Put that in appendix. Other short working, you can still put in a letter one. Now, spreadsheet must use formula. Do not use calculator. Press the figure and then key in your figure into the cell. Cannot, must use formula because marks will be given on for the working. Working means the formula. If you don't want to show formula, you want to press the calculator, show the final figure in a cell, if you want to do that, you must separately type up your working. In that case, it will take time. So you have to decide what are the ways to save time. Okay, these are the topics you need to cover. All right. That's a lot of topics. The ATX is quite a white paper. Don't give up. If you cannot get through for a certain sitting, you don't just tell yourself the paper is difficult, that's why you cannot pass, you want to give up. It's actually you haven't given yourself enough chance. Now, in order to pass, I told you the question is made up of many topics. The examiner makes sure you really study in order to pass. She doesn't want you to spot topics. So remuneration package, the one I highlighted, you see the sittings that came up. September, June, March, December, all came up already. I highlighted for you. So if you ask me, I will not study remuneration package anymore. Gratuity just came up. So loss of employment haven't come up yet. So I will study this. ESOS haven't come up. Resident status haven't come up. Okay, for the past, how many sittings? 4 sittings. When 4 sittings will include the secret sitting as well. So September and March, these are the sitting most of the time that we don't get any published questions. So I call them as secret sitting. March 2 to 1, I think we have the answers. Okay. Can we use 100,000 K? I don't think so. If it is a theory answer, you are not supposed to use 100,000 K. I can as a lecturer because I passed already. You are going for the exam, So your examiner is actually a tax practitioner. So she wants you to present your answer as if you are writing an advisory letter to your client. When it comes to professional firm, when they write advisory letter, everything must be very very proper one. You cannot put 100,000 K. Your client read, they will frown one. So you must write properly 100,000. Okay. ESOS haven't come out. It used to be very popular. It hasn't come out for a long time. I don't know when it will come up again, but for such a long time it hasn't come up. The resident status ESOS. Okay. The derivation taxability of employment income, loss of employment. Then we will have incentive. I think incentive, you got no choice. So far, every sitting RA comes up. I don't know when they will stop setting RA. Okay. I really don't know when they will stop setting RA, but RA is like, you look at this, come up every sitting. Until the examiner stops setting RA, then we can say, okay, we will stop studying RA. Not stop studying RA, like we will not spot RA. But she has never failed to set RA for the past 3 sittings. we need to study RA. Okay. In fact, all the incentive you need to study. This one just came out only. So group relief is not so popular. In practice, I think very hard to claim group relief also. But it has come out already. Labuan, we have to wait. I think that the examiner wrote an article on Labuan. She was waiting for the chance to set Labuan. But I think she was waiting for all the amendments to be put through first before she wants to set Labuan. Labuan, the last amendment that was being effected was like the day before our budget, right? So it is like not it will not be, she will not be in time to take up all those new amendments. So I'm not sure whether I don't think you should let go. You should know Labuan also. If I were her, I will be like waiting for all the amendments to put through first. Okay, now principal hub is not, we don't have to study principal hub. Okay. Pharmaceutical products, no need. All these, no need. It is just normal pioneer status, RA, ITA, export, Labuan, R&D. This is the normal incentive that you need to study. No need to talk about principal hub. All those is not in our syllabus one. Okay. Now, sorry. All right. Now, so incentive, you need to study everything except you can let go group relief, I think. Okay. Now, that's a lot to study. Tax admin, it also come up like almost every sitting, but it's not many marks. But it's those marks that you do, you will help you to get the last 3 marks to pass. So incentive, I think stoppage, no need to study. So appeal, all these are important one. Employees duty, I think no need to study. Now, special person doesn't come up every sitting. So what came up was IHC, LLP, trust. So what is left? Unit trust never come up one. For I don't know how many years already never come out. I don't know why. But eventually one day it will come out. I don't understand why she doesn't like to set unit trust. So what lesson no need to study one. Okay, leasing company lesson no need. So what is important now will be your REITs. There's only one question from unit trust. I really scared that it would suddenly come up, pop out. Settlement, because this is in examiner's article. Executor, you cover this. Now, there's one topic always come up one, never fail one, is taxability. They give you a receipt, whether it's a capital receipt or revenue receipt, subject to tax. Or they give you an expenses deductibility. They give you an expenses, whether it's capital expenditure or revenue expenditure. This one, she never failed to set every city. Of course, when we want to know if taxable or not, we have to talk about patches of trade. So important. Now, then international tax. All this anti-avoidance, transfer pricing, withholding tax, every sitting come up without fail already now. Until she decided not to, is, let's say December 2021, she wants to stop setting withholding tax, then we know, okay, she's tired of withholding tax already, she doesn't want to set already. But meantime, it's every sitting withholding tax. Every sitting is RA. Now, double tax relief came out already. So this one, even though came out, I still think is important. Transfer pricing important. In practice, transfer pricing is the hoo-ha now. These two, this ESR is important because it's in the examiner's article. All right? Okay. So she can actually put settlement into the personal tax com question. There's always one personal tax com question. Okay. So now, sorry, what happens? Okay. Okay. Then we have tax planning. There are many things in tax planning. Rightly, if you are well prepared, you should be going through all the tax planning questions. So it covers like how to use laws, how to use CA, IBA, agriculture allowance, and then control transfer, your section 35(5) stock. What happens if you actually set up a branch versus subsidiary, small value asset? All this is inside tax planning. So it's actually very, very wide under tax planning. If you are well prepared student, you find that there are many tax planning questions. In our past year, you need to go through those tax planning questions to let's enhance your knowledge. Okay. Now, then here, service tax as sales tax and service tax, of course, must know. It comes up every sitting. What within service tax will come out, what within sales tax will come out, then is very difficult to actually spot within them. So I would propose, it's just like RPGT, you need to study everything. Your RPGT, same thing, is a topic that comes up very, very frequently. The one that recently came out is your asset permanently attached to land, whether this is enhancement cost or not. It just came out, allowable loss. Then RPC, small part of September, small part, a big part in June. Okay, a very complete question in June. September, small part only. And then para 3. So these are the topics that will normally come up. So you will ask me again, you will ask me, generally incentives will come up. That means you study all the incentives. RPGT, you need to cover all the RPGT because we do not know which part of RPGT will come up. SST, cover all. Tax planning, all this. That's a lot. You are covering a big part of the syllabus already. So individual tax com, I'm not asking you to study what you have studied in the lower tax paper. Those topics will not come out. So all this will be like settlement. Okay, ESOS can come out in the personal tax question. And derivation of income. Even income from REITs also, they can put it in a personal tax question. So your tax admin, your REITs, your examiner's article, very, very important. Now, instead of going into, actually my next topic, I told you I'm supposed to do RPGT. Then after that, we are supposed to do incentives, then tax planning, incentives, then tax planning, then examiner's article. Now, this is our aim for today. Now, incentive, I believe that most of you have already learned your incentive from your lecturer. So is tax planning. Okay, I want to straight away move into the examiner's article. So that if there's any topic that comes up from the examiner's article, you can at least able to do those topics. Okay, I think very few examiner will really cover the examiners. Very few lecturers will really cover the examiner's article. So now I want to skip to this part. After I finish this one, then only we will come back and do tax planning. Then after that, incentives. Okay. Even if I miss these two, your normal class lecturer would have covered for you, but not this. So I want to cover it now. Double tax relief, it actually came out. This one, you're talking about double tax relief, right? So I highlighted yellow color. It actually came out in June 2021. Double tax relief. Leasing and option under RPGT. RPGT, leasing is important. Option, I have never seen option come out under RPGT. In practice, I've never seen anybody buy a property using option before. Okay, so lease, yes, but not option. I've never seen a pass here. So if you ask me, I say I would think you can actually skip option but not lease. Double tax. Double tax, I told you already, came out in June 2021. You're talking about double tax relief. Are you talking about double tax relief or you're talking about international tax generally? Are you talking about all this international tax or you're talking about double tax relief only? The rest of it, international tax, you need to cover. You want to study double tax relief? Not so bad lah, no? But not the rest. When you say double tax, which part of the double tax are you referring to? Okay, so we will move on. Page 15, let me see. The examiner's article. Okay, guys, examiner's article cover on this one. This one I think your lecturer has taught you already. Section 44. We are talking about a dormant company. The examiner did not cover much on this, so I just briefly explain. If the company is dormant, if the company has got more than 50% changed in shareholders, you satisfy these two conditions, then the CA plus the loss will be disregarded, cannot be carried forward. Okay, this is an anti-avoidance in the sense that you will have, let's say, a company cease business already become dormant. There are people who, where the company already ceased business, you can actually apply to these Securities Commission to strike it off as a dormant company, or you can actually apply to wind off this company, but that will be expensive. Striking it off will be the best method. But the third method is, instead of striking it off, you can actually sell off your shares. So if you sell off your shares, it's a dormant company, you sell off your shares, then you find that definitely there will be a 50% change in shareholders. So your new shareholders take over. Then normally when they take over a dormant company, what is the purpose? Is because when they want to, instead of incorporating a new company to run business, they find it faster if can buy over a dormant company inside, got no asset, no liability, clean one. They buy over the shares from the shareholders. So then they inject new business inside. So when they inject new business inside, this business is profitable one, very profitable. And to stop people from going, hunt for those dormant company which has got CA brought forward and loss brought forward and utilized, and then you inject a new profitable business inside, and then this new profitable business can be reduced by the loss brought forward. CA very difficult to use because it must be same business, then only it can be reduced by CA. There are people who do this. So the Director General come up with Section 44(5). So long as a dormant company and there's a change of shareholders for more than 50%, to stop people doing this, they come up with these two conditions. So if such thing happen, then the CA and the loss cannot be carried forward. That means it cannot be used to set off against your profit from your new business. Okay? Are you able to understand or not? The incentive I will cover later on will be, the incentive I highlighted: pioneer status, ITA, RA, export. That's it. Now, so this will be Section 44(5). It's not elaborated in the examiner's article, but she did mention it a bit. Control transfer, I believe your lecturer would have covered control transfer for you in a class. It's not also elaborated in the examiner's article. So I actually don't have time to go through the principles of control transfer. I want to look into settlement. Okay. After that, into all this is budget 2021. Then, of course, this one ESR hasn't come out before. I will then focus on these three topics. This one also I will do. This one, no, this one I will not do. It will be like covered by this, so I will do this. All right. So these are the few topics that I will cover under the examiner's article. Now, settlement. Now, firstly, you must understand what is settlement first. Maybe I show you an example why the settlement section has been introduced by the Director General. Look at this. You're supposed to compute money's tax payable for YA 2021. So this is money. YA 2021 tax com. Money is a widower, so what relief that he cannot claim? If the question say he's a widower, so what relief that normally you cannot claim for him? Good. So there shouldn't be any wife relief. No wife relief of 4,000. Okay. Now you don't have to study all the relief. There are a lot of amendments on the relief, but the reliefs that the examiner examine is always like self-relief, 9,000, wife relief, 4,000, is like EPF, 4,000, life insurance, 3,000, normal child relief is 2,000, the enhanced child relief, 8,000. That's all you need to know. The rest of the changes on the relief is not for ATX, it's for the TX paper. The examiner, to a certain extent, is not allowed to set questions from the TX topic. Okay, the examiner has to focus on the ATX topics. So don't need to go and do the TX question all over again on personal tax. Is actually not our focus totally. Now, money has got a statutory income from the motor business of 80,000. So this is the section 4A motor business income. He also has rental income from the condo 120,000. So that's section for the rental income. So the total income is 200,000. Now he has got a son, Ali. Ali is 20 years old. So above 18, studying ACCA in KL, plus study tertiary education. So what is the child relief? Higher education. What is the child relief? Is actually 8,000. In practice, ACCA, I don't know about your parents, but some of the Inland Revenue Officer, they don't know what is ACCA. So you really have to explain to them ACCA is higher than even degree. To them, ACCA is like equivalent to diploma, so they don't want to give 8,000, you know, sometimes. So that is in practice. For exam, our ACC is very high standard. Okay, is 8,000. Now, Ali did not derive any other income in 2021. So the relief will be 9,000, 8,000. He's got a very high chargeable income. He has hit tax bracket at 24%. This is the total tax that he has to pay. 30,620. He pays a lot of tax, very patriotic to Malaysia. Okay, come. Next, part 2. Explain, then Manik heard from his friend that he's able to save tax if he transfer his condo to the son as a gift. He needs further clarification on this matter. Can he save tax or not? Let's look at this. So now he wants to transfer this to the son. So his income dropped to 80,000 from 200,000, dropped to 80,000. That's the total income. He will not be able to claim child relief because the son now will have rental income of 120,000. This is more than the child relief of 8,000. So the father cannot claim child relief on the son anymore. You notice that his chargeable income dropped to 71,000 instead of 183. So he will pay tax only 4,610 instead of 30,620. What happens here? It is this income that has been split to the son. So the son, instead of having zero income, he has got 120,000. He's got his child relief. If it does not, self-relief, if he does not have income, he will not be using his self-relief of 9,000. He will not be using his low tax bracket. The first 5,000 is 0%, you know, then slowly 1%, 2%, 3%. If Ali Manik shift the rental income to Ali, the advantage is he can make use of his relief, can make use of his low tax bracket. As a result, you total up his tax plus the son's tax, he only need to pay tax 17,950 compared to 30,620. All right, that's a lot of tax savings. So this is what people like to do. They will look for their children who is very young, who has got no income, then split the income to their children. And then, of course, this tax, maybe this rental income, although the name of the condo is in Ali's name, is legally belong to him. So therefore, it should be taxed on him. But you never know the rental income. Maybe the father actually can use the rental income. It's not actually given to Ali. And the father will then pay tax for him. So so this is done for the purpose of reducing the tax for money. So in this way, in this case, the Director General will come up with Section 65(1) to stop it. So let's look at, this is page 19. If Ali is below 21 years old, shouldn't we treat this as a settlement? Yes, now we are going to study. We need to treat as a settlement. So how to stop this from happening is, now we will study settlement. Okay, let's see. Firstly, you have to identify just now whether when money was transferring the condo to the son, is it considered as settlement? Now we give a negative definition for settlement for the purpose of exam. Settlement is an income that is an asset that is transferred to another party without adequate and valuable consideration. For example, a gift of condo. Money transferred to the son without as a gift. There's no valuable consideration. It's zero consideration, nothing, no adequate valuable consideration. Now, but if this transfer is actually by court's order, then it's still not settlement. So money actually voluntarily transferred to the son. So it's not under a court's order. So thirdly, it is not transfer from the employer to a widow or widower or beneficiary of deceased employee. So since it's not these three, then it's a settlement. If any of these three, then it's not a settlement. So money transfer the condo to the son is a settlement, okay? If it is a settlement, do we tax money or not? Then we will see whether it satisfies Section 65(1) or Section 65(2). So we'll see what is Section 65(1). Now, Section 65(1) says during the lifetime of the settler. Settler is a transferor, lifetime. Means he's not dead now. He either pay income or asset to a relative, or we call it transfer income on asset to a relative. It has to be a relative. Number one, lifetime. Number two, relative. And this relative must be below 21 years old. And also unmarried. When there must be a cut-off date, you cannot make the person be below 21 years old unmarried forever. Okay? It has to be beginning of the YA. That is point number 5. Now, if you read the examiner's article, they didn't say it's beginning of YA. The act actually say YA, but the examiner wrote beginning of the basis period for the examiner's article. Okay? There's no such thing like the person is below age, then he doesn't need to pay tax. There's no such thing. If you are below 21 years old, but you are rich, you have to pay tax so long you have income. We don't care whether the person who received the income is below 21 or above 21 or maybe over 100 years old, no energy to pay tax already. No, there's no such thing. Okay? If it is under death, it will be under will, you're right. Oh, now, under Section 65(1), there are so many conditions. If this happens, then the income, although legally transferred to Ali already, is still deemed to be whose income? Deemed to be income of money, income of the settler. Why? Because Director General will view this as a means of money trying to split his income to Ali. Ali is actually his relative, son, a relative. And we do not know, they mention how old he is. Yes, 20 years old only, so below 21. Did they say he's not married? We assume he's not married, make reasonable assumption. Below 21, you shouldn't be married, right? Are you all married? Unmarried? As at what date? What date? 1/1/2021. Therefore, this income, who do we tax? This 120,000, who do we tax? This 120,000 rental income. Y means income. 120,000 rental income will deemed to be whose income? Deemed to be money's income. And we tax on money. What is the purpose? This is called Section 65(1), an anti-avoidance section. The Director General comes up with this section to stop money from splitting his income to Ali in order to avoid tax. That is called an anti-avoidance section. Okay? Now, let's continue on. We will do this past year question. Modified past year question. Now you're supposed, the whole question is a computational question. You're supposed to compute Sati's total income for YA221. Giving brief explanation on the treatment of the rental income. They want brief explanation. So brief explanation, you don't write your principle and your application separately. You try to combine it, okay? No need to be so detailed. Before we can do this question, we will also, we will do the question now. Let's see. Now, we are interested in doing com of Sati, not com of Param, okay? So in 221, Param gifted a rental property to Sati, who turned 21 years old on 1st of April 2021. The rental income in 2021 is 180,000. This is for 12 months. Now, firstly, I want to know whether is this settlement or not. Gifted. So there is no adequate and valuable consideration for the received by Param for the transfer of real property. Is the transfer based on court's order or not? Not based on court's order. Is it transfer from employer? Not from employer to widow or widower or beneficiary of deceased employee. None of this. So my conclusion is it a settlement or not? Yes, it's a settlement. If it is a settlement, then I check section 65(1). Now, you must know also that Param died on 30th September 2021. Param died on 30th September 2021. Ayo. Okay. For section 65(1) to be applicable, number one, who must be alive during the lifetime of who? Param. Okay. So during lifetime of Param. So Param must be alive. Then only DG can say he's trying to avoid tax. Then therefore we tax him. If it's dead already, a dead person wouldn't be avoiding tax. So we cannot, the DG cannot invoke section 65(1) on somebody who has died. Very logical, right? Good. So during the lifetime, Param transfer the rental property to Sati, to a relative. Who is this relative? Sati. Who is she? She's the granddaughter. Relative. Is she 21 years old? I said, what is the cut-off date? Tell me, what is the cut-off date I need to look at? What is the cut-off date? The cut-off date, first date, yes. 1st January 2021. Okay, first day of the year, 1st January 2021. So on 1st January 2021, she turns 21 years old on 1st of April 2021. April Fool Day, she becomes 21 years old. Okay, so then on 1st January 2021, is she 21 yet or not? Is she 21 yet or not? She's not 21 yet. So on this date, she's below 21 years old. Plus, we assume she's not married, okay? If the exam question is silent whether she's married, that means she's not married. If the examiner meant her to be married, the examiner will tell you that she's married one. Now, we assume she's not married. So she's not married, so then the income was deemed to be, actually the whole income of 221, the whole rental income, this 180,000, should be taxed on Param, is deemed to be income of Param. But this is section 65(1), but section 65(1) is only applicable during the lifetime of Param. The moment Param died on 30th September 2021, the next day, 1st October 2021, can section 65(1) be applicable anymore or not? Yes or no? No. So our income, we need to time abortion. You're right. How many months that he's alive? 9 months. He's alive. So I will take 180,000. So I will times 9 divided by 12. We will then tax Param. So we will tax Param on the 9 months. We will tax Param. It will fall under section 65 as a settlement. So we are not going to tax Sati. Now, after his death, let me ask you a question after his death. Will the rental income be taken over by the executor or will it be passed to the granddaughter? That 3 months when he has already passed away, the 3 months rental income, do we tax granddaughter or do we pass it to the executor? We will tax Sati, we don't tax the executor because the property already has been passed to Sati, the granddaughter. You know, the property the title already passed on to the granddaughter. So it will not be taken over by the executor anymore. So executor is out of the story. So after that, this is during lifetime of Param. This one is Param died already. So we will tax Sati. Following the demise of the grandfather, the rental income taxable in the hands of Sati because the property already legally passed on to Sati. Now, then let's look at the next one. Param also has got another rental property from another property. Rental income from another property. The rental income is 3,000 per month, which he rented out with effect from 2019. On 28 February 2021 and 31st October 2021, Param also received interest from FD, 20,000, 30,000. Will this affect Sati's tax com or not? Will this affect Sati's tax com or not? Will this affect Sati's tax com? You know, they say that Param has got rental income from another property which was never settled to Sati, and then the interest from FD also never settled to Sati. So will all this income affect Sati or not? No, it will not affect Sati. All right. Yes, it will go into the executor's com. All this will go into the executor's com. It will not affect Sati. Okay, good. Now, then we find that on 30th of December 2017, 12,000 will be paid for Sati. For the period October to December 2017, then on 31st, what will be paid? A prorated sum. Okay, this one. Param died domicile in Malaysia on 30th of September 2021. His will stipulated that an annual annuity of 48,000, a prorated amount of 12,000. Can you put the word annuity? Can you change this to 2021? This one also 202. A prorated amount of 12,000 annuity will be paid to Sati from October to December 2021. Change it to 2021. Okay, how come it's 12,000? Annuity is supposed to be 48,000. So if it is a prorated amount, that means Sati will only receive it after the grandfather died. If the grandfather hasn't died, she will not receive annuity. You don't receive annuity from a person who is still alive. Unless the person who is alive settle the income to a trust, then you actually is a beneficiary of the trust, then you receive annuity from the trust. But you don't receive annuity directly from an individual who's alive. So therefore, Sati will not be able to receive any annuity from Param directly. She will only receive it after he has passed away. She will receive it from the executor. So she will not be able to receive the whole amount, 48,000. It'll be 48,000 times how many months did Param died? He has been dead for 3 months, so 3 divided by 12. You will get 12,000. So this 12,000 is payable to Sati. So when it's payable to Sati, when Sati receive it, is it taxable on Sati or not? Is it taxable on Sati? As what income? As what income? Yes. So this is taxable on Sati as Section 4E income. Now, so we will look at the answer. You will see 12th annuity here taxable as Section 4E income. Next one. But what did she do with the money? She donated the entire sum, 12,000, to an approved orphanage. So this amount is restricted to 10% of the aggregate income. We will look at aggregate income later on. We still haven't managed to put in all the figure until we can find aggregate income. So we will have this one now. There's another settlement. Before we look at this settlement, let us read up here. Look at page 19. That's section 65.2. So the examiner actually emphasized on section 65.1 and also section 65.2. Especially section 65.1, there were quite a lot of examples of section 65.1. 65.2 also she gave example. So this one is, we don't care whether the income has been settled to a relative or not. So the conditions here is not the condition here. So you can settle it to a non-relative, can settle to the girlfriend, settle to your best friend, or settle to your, if possible, settle some of your income to your lecturer also, we don't mind, okay? So there is power of revocation given to the settler. But you settle, let's say you settle your income to me. But then when you settle your income to me, we need to sign agreement. You make me sign agreement. For me, you don't sign agreement, so never mind, you want to give me money, I will take one. So you make me sign agreement. Inside your agreement is stated that if you feel like it, you can take back the money anytime. That's the settlement that you give to me. Okay? So for me, okay lah. You want to give me money, I take lah. When you say you, as and when you want the money, you take back the money, from certain month onwards, you take that the money. Okay, fine, no problem also. As and when you want, you take back all the money. So I don't. Now, whether you take back or not, it does not matter. But there is a clause inside the agreement saying that you have the power to take the money back. So revoke your settlement. Okay, you don't want to settle to me anymore. If you are not happy with me, I don't give you enough tips for exam, you're not happy, you want to take back all the money. So revoke all the settlement, revert back to you or your spouse. Who is taxable? The settler is deemed to be taxable. You'll be taxable then. Even if it's not reverted back to you, revert back to your spouse, it is still the settler is taxable, not the spouse who is taxable. Okay? Good. So now, let's look at this example. Let's look at this example. Sati, she has got a best friend. Wow, best friend. Now, this best friend established a business selling Korean branded cosmetics in Lazada Mall. So on 1st July 2021, the best friend come to Sati and tell her, okay, we enter into agreement. Then the best friend will make Sati her business partner. Then she will tell Sati, you don't have to pay any capital one. But she will give Sati 30% of the share of profits. If you are Sati, will you accept it or not? Of course you accept. Okay. So this 30% of the share of profits, the statutory income, the share of the statutory income is 40,000 for the 6 months period. When did the settlement start? It's actually 1st July 2021. How do I know that it is a settlement? How do I know it's a settlement? Tell me. How do I know it's a settlement? Then I will get back to just now my rule here. Yes, no valuable and adequate consideration. How do I know there's no valuable and adequate consideration? because it's mentioned here that Sati is not required to contribute any capital to be a partner. So she doesn't need to contribute capital, no need to put in effort also, just don't need to do anything. Goyang kaki, then you get how much? The statutory income of 40,000. Isn't life so beautiful? Okay. So then the Director General will be suspicious that Kiki is trying to split her income to Sati. But it's also when the Director General is suspicious of this, and maybe Kiki will say, oh, we are very good friends. That's why they are doing it for the purpose of friendship, not for the purpose of avoiding tax. But when the Director General read the agreement, they find out that Kiki is not so nice after all. Kiki, within 1 month notice, can actually revoke the arrangement unilaterally. That means even if Sati disagree, it does not matter. She will have the full power to revoke the arrangement, meaning that she can make Sati cease to become a partner, okay? Terminate her, won't let her become partner. Then all the profits initially paid her how much? 30% of the profit. All the profits will be reverted back to Kiki. So this one we cannot use section 65(1). Because this happened, when did this happen? 2021 because they are not relative, they are friends only, so it cannot be section 65(1). So the Director General, if they want to stop Kiki from avoiding tax, and they want to tax back Kiki, they cannot use section 65(1). They can use section 65(2). Why? Because it's stated here that Kiki within 1 month notice can revoke the arrangement. So the settlement is revocable. Then the money go back to who? The money will go back to Kiki. So in favor of Kiki. So then who should we tax? We tax Kiki. We don't tax Sati. Okay. So we will have this. Is transferred to Sati without capital consideration. It's a settlement. And Kiki has the power to revoke and revert the business income back to herself within a month's notice unilaterally. So Kiki is taxed on the statutory income. It's 0, 0. All right. Then after that, Sati was given a scholarship worth 80,000 to spend in 2021 studying classical music in India. Now this scholarship, whenever anybody receives scholarship, is under Schedule 6, that all the scholarship is supposed to be tax exempt, specifically tax exempt. So scholarship is Schedule 6, Para 24. No need to memorize the para. No need to memorize the Schedule 6. Just mention if they want to know the reasons why it is not taxable, then you just mention it's specifically exempt under the Act. So it should be 0 for scholarship. Okay, then you will have a total income of 57,000. Then from the annuity that Sati received, where is the annuity? This annuity that Sati received, she donates it to an approved institutions. So she can get a deduction or donation restricted to 10% of the aggregate income, 5,007. She donated 12,000, can get deduction 5,700. This is a total income. Why I stop at total income? Because the examiner's question asks for total income only. What happens if you compute up to tax payable? If you compute up to tax payable, will marks be deducted? As I told you, there's no negative marking in ACCA. They cannot deduct marks. They can just ignore only. So nothing happens except that you always spend your time. You're using time from next question to do something which is out of point. Then, as I told you, each question, each question we cannot overspend our time by how many minutes, tell me? 3 minutes, 3 minutes, that means not 5 minutes, 3 minutes. You cannot overspend your time by 3 minutes. 3 times 4, the last 15 minutes, you already overspend your time 3 minutes, 12 minutes gone already. You only got 15 minus 12, 3 more minutes for checking only. How much can you check for 3 minutes? You cannot check much for 3 minutes, you know. So you imagine it's like, wow, you really have no time to check anymore. Now this 7% no more already is 10%. It's no longer 7%. We don't have 7% deduction for donation. It's all 10% already. No more 7%. That is not even budget 2021. That's budget 2020. Individual and company, yes, restricted to 10%. You're right. So now this end of the question. You can ask question already. If you don't ask a lot, then I can move on to the next topic. That would be very nice. Okay, RPGT only. Let me see. Somebody asked, Dayang asked, how do I differentiate? It is section 65, one question to RPGT, no gain, no loss. Both can be gift of love. Okay, you see, this section 65, one. And your para 12, for love and affection. So much love and affection. RPGT. When we talk about RPGT, we transfer what? We transfer parent to child, grandparent to grandchild, then we have husband to wife. We transfer real property. We transfer chargeable asset, or we can transfer RPC shares. So number one, it has to be gift of chargeable asset. Number two, I know it's also transfer between relatives. But the relatives here are specific relatives. Parent to child, grandparent to grandchild, husband to wife. So it does not involve uncle to niece. Okay? Cousin brother to cousin brother, brother to sister, no. There's no such thing called no gain, no loss. We are taxing on the asset. We are taxing on the condo. Section 65(1), or let's say here grandfather, transfer to grandchild, sati. This is grandfather, okay? We are not taxing the what property did I transfer in this question. They just say rental property. Are we taxing the rental, or are we taxing the property on the father? Are we taxing the rental or taxing property on the grandfather? Under section 65(1). We are taxing what? Under section 60, renter. We are taxing renter. We are not taxing property. So if you say you want to tax property, then this property is a real property, is a chargeable asset. It will go back to para 12. So this is an income, revenue income. It goes under Income Tax Act. You see the word Income Tax Act? This is a tax on income. That's why the name is called Income Tax Act. It's not a tax on property. Property fall back to RPGT. So there is a clear line between income and chargeable gain. There's a clear line between section 65(1) and para 12. Yes, you're right. If the question asks on RPGT, then it will be no gain, no loss that we discussed. You are right. So it gives opportunity to the examiner to lump a settlement question together with an RPGT question. Lump up, put inside one question. So it can happen. No problem. Okay, so we finish settlement. Now we move on to another topic that is covered by the examiner. your due to be paid, your loan transaction between connected person, between related parties. I don't have notes for this. We are going to use this question as a note by itself. We are going to use the answer as the note. Okay, let's read this question. You're supposed to explain the basis and the timing of the following if the 1 million is treated as loan at market interest rate. How are we going to recognize the interest income for big? We don't know who is big, whether it's a lender or borrower. How are we going to claim deduction for little? State YA. 7 marks. 7 marks is a lot of marks. Okay, 7 marks times 2, maybe you have about 14 points. Not exactly, you don't need to calculate exactly 14 points, but it's about there, okay? So the points will include principal plus application. I'm sure we can reach about 14 points. Definitely can. Now, let's see. We have little. Little has a paid up share capital of 1.8 million. Wholly owned subsidiary of Big, which has a paid up share capital of 20 million. So little is little an SME or not? Can you tell me whether little SME? Is little an SME? No, little is not SME. Although the share capital is very little, only is 1.8 million, but is controlled 100% controlled by Big, which has a paid up share capital of 20 million. So the tax rate of little is 24%. Okay, it's not required one. Just for discussion purposes, we discuss only. It's not required by this question. Now, so although profitable, little has experienced cash flow problem. In July 2017, Big gave loan of 1 million to little. So Big gave loan to little. So we have Big here. Big gave loan to little. All right, good. And then what is the purpose of the loan? To settle trade debts, pay remuneration to the employees. Is this important or not? Is this detail important or not? Is this detail important? Yes, important. Why is it important? Why is it important? It will let me know the tax treatment of little. Little will have to pay interest expense back to Big. So it has to pay interest expense back to a Big. In order for me to know whether the interest expense is deductible or not, interest expense, whether deductible or not, we look at section 33 1A if the interest expense is incurred in respect of a loan. All right. Is whether it's deductible or not will depend on how the loan is being used. So this interest expense come from a loan which is obtained by little from Big. How is little going to use the loan? To settle trade debts, to pay remuneration. So if the loan is employed in production of income, then the interest will be deductible against this business income. If the loan is laid out on asset, like the loan is used to buy factory, the factory is used for production of business income, then the interest will be deductible. This is section 33(1)(a). This section 33(1)(a) comes out almost every sitting one. So you must know your section 33(1)(a) very well. So now the section 33(1)(a) says whether your interest deductible will depend on how your loan is being used. Your loan is used to settle trade debts, pay remuneration, staff remuneration. So which one is it? Is it this one or is it this one? Is it number 1 or number 2? Is number 1. So your loan is employed in production of business income. Therefore, the interest will be deductible for little. All right? Yes. So it will be deductible for little. They are not asking whether they want to know the interest income once deductible. What is the timing? When will it be deductible? Let's see. Okay, when will it be deductible? So to enable little to continue to operate the retail business, so the loan will be used for this to continue to operate the retail business. Now the loan to little is charged on the prevailing market interest rate. So there's no transfer pricing issue because it's charged at market rate. So no transfer pricing issue. Transfer pricing issue will only arise when 2 things happen. What are the 2 things that happen? Then only transfer pricing issue will arise. Tell me. What are the 2 things? Associated companies, not arm's length. You are right. So transfer pricing issue will only arise when the interest is not charged at arm's length price, not arm's length price. And also the transaction are between associated parties. So big and little, they are definitely associated. That's 100% subsidiary, right? Little is 100% subsidiary. But then the market rate is the interest rate is the market interest rate. So it's actually charged at arm's length price, although it's a transaction between arm's length between associated parties. So there is no transfer pricing issue in this case. The question is not asking about transfer pricing. Now, the loan given to little is from 1st July to 17. So the loan given to little is actually 1st July to 17. 1st July to 17, what is the year end of the company? The year end of the company is 30th June. So 1st July 2017, this will go into 30th June 2018. That means in the accounts, for little, they will then accrue for the interest expense every year. They will accrue for the interest expense every year, charge out to SOPL for 2018. Let's say now is 2021, charge every year up to 2021. Then for big inside the accounts in the SOPL, they probably have an interest income receivable for accounting purposes. The interest income receivable from 2018 to 2021. All right. But for tax purposes, it's another story. Now, even though the interest actually, the agreement say, okay, start to be effective from 1st July 2017, but there's no interest due to be paid by little. Until when? Until 1st July 2022. So for tax purposes, we look at interest due to be paid by little. When is it due to be paid by little? It will be 3 years later, 1st July 2020. 1st July 2020 will be inside what YA? 30th June 2021. So this is 2021. All right. So the situation is, let's look at this. I need to answer the question for big first. How big is going to recognize this interest income? After that, we will look at how little is going to claim deduction on the interest expense. And then state the YE. These will be the 2 issues that we need to handle. Okay. Now, we don't have a problem of big owns how many percent of little? 100% of little. So definitely no question whether they are related or not. They are definitely related parties. Whether big there's no need to check whether big can actually appoint at least one director in the board of directors of little. You already have 100%. So long more than 51%, you definitely these are related parties already. Okay. Now let's look at the question. Now I want to look at what is the tax implication of PIC. So PIC will receive interest income. That will be interest income for PIC. So under section 27, interest income, this interest income for PIC, is this section 4A income or 4C income? Is this a section 4A income or 4C income? And this is a 4C income. How do I know it's a 4C income and not 4A income? How do I know it's a 4C income and not 4A income? It's not a bank, not a banking institution, all right? Actually, the Act never mentioned that it's not a bank, then it's a 4C income. What exactly did the Act mention? No lah, you all bluff me one. Okay, tell me. The conditions to tax interest income, no, it's not all this. Is the mortgage and the debenture must be a stock in trade of BIC. That's one. Or BIC has a money lending license, then the interest income will become 4A. If you cannot satisfy any of these conditions, that means your mortgage is not your stock in trade, your debenture is not your stock in trade, or you don't have a money lending license, then the interest income will become a section 4C income. Now, if it is a section 4A income, then we don't have this problem. It's a section 4C income. 4C income is a non-business income. Non-business income, we don't tax until it is received. Understand? We don't tax until it is received. Okay? Now, receive, we tax. Not received yet, we don't tax. When received, we also don't tax in a YA of receipt. How do we tax? We will revise COP, we relate it back to the period when it is first receivable, we tax in a YA, it is first receivable. Understand or not? So, for example, okay, we learn this first. Now, for example, our case here, it is receivable for YA up to what YA? Tell me. Your interest income for PIC is receivable from what YA to what YA? Based on the question. 2018 to 2021, very good. It's receivable from YA 2018 to 2021. But when PIC submit the income tax return form, it would not have included the interest income as section 4C income in the income tax return form. Why? Because the interest income was never ever received. Now, then, how do you know what is the definition of receive? Important, because once received only you can tax. So what exactly is receive? So receive means if you actually receive the money, of course it's received. But it's not necessary that you receive the money, then only consider as received. So long the lender is able to obtain the receipt on demand. So that means if smaller doesn't want to pay you, you can then sue small in the court to demand for the money that's already called receipt. If they are not related, definitely once you issue an invoice for your customer, then your invoice say, okay, I give you a credit period for 1 month. After that 1 month you don't pay, I'm going to take legal action. Does the lender has a right to take legal action? Yes, because already issued out the invoice and already mentioned, okay, I give you 1 month credit period, don't pay. Then you can take legal action. Has the right to take legal action that's called obtainable on demand. But in exam, you don't say you have the right to take legal action. You just say, what is the meaning of receipt? Receipt means the lender can obtain the receipt on demand. That is called receive already. Not necessary the money must be received by PIC. Now, that is for non-related. That means if PIC enter into a loan transaction with other parties not related one, this will be the rule. So able to obtain the receipt on demand is considered as received. Then you will bring the interest income to tax. When you tax in the YA, it is first receivable. Now, for the purpose of related companies, the definition to be able to obtain the receipt on demand is different. They say that the lender is able to obtain the interest on demand when it is due to be paid by small. Due to be paid, they only consider as obtainable on demand. Once obtainable on demand, the interest income can be brought to tax on big. Then when you tax in which YA? YA, it is receivable. All these are principle or application. Tell me, all these are principle or application. The first paragraph, they are all principle. So your examiner writes down all principle. So now, application. Now, the loan extended to small, starting from what date? 1st of July 2017. So the first YA is YA 218. The interest is supposed to be receivable, but it's not receivable, it's not received yet, it's not obtainable on demand yet, so that it should not be taxed on paid yet in 218. So when will it be due to be paid? It's due to be paid from 1st July 2020. This one, due to be paid. That means the interest income become due to be paid to BIG only in YA 2020, all right? And then BIG has got control over little, is 100% shareholding to show that it's actually loan between related parties, this application at the bottom here. So then BIG is able to obtain the interest on demand when the interest is due to be paid because they are related parties. That will be YA 2021. So as a result, the interest income is taxed on BIG from can be brought to tax in YA 2021, but when you tax it, you will tax it in the YA. It is first receivable. YA first receivable is YA 2018 to 2021. You need to revise card and take in the income. Are you able to understand or not? What is the difference if they are not related? If they are not related, then we have to the right to obtain the receipt on demand will be based on the invoice date. You know that you take the invoice, so long you can sue your borrower for the money, is considered as obtainable on demand. What they worry here is the obtainable on demand, how to interpret obtainable on demand. There is no definition in the Income Tax Act. When I say you can sue, is something that we will normally describe obtainable on demand in practice. Maybe there are some people who say, okay, look at small don't have money one. Small got no business activity. The business making loss and don't have money. So big will never be able to get any money back from small, because you try to obtain on demand also useless. You sue also useless. They go into liquidation. Then they will pay, the money they have is so little. They will pay off all their secured creditor. Pay off to the government and everything. Then after that, nothing to be paid off to pay. So obtainable on demand will not be the invoice date. You can actually argue. So if they are not related, we don't have a problem one. They are not related, then normally we will say receive it and is considered as obtainable on demand, and receive will be the same date. Normally we don't argue so much, because if they are not related, big will not let small to avoid paying the tax. They will not allow small to drag the debt for so long because they are not related. They will definitely chase small for the money. If they are not able to get the money, it's because of some commercial reasons, because maybe small really don't have money. That's why they cannot receive the money. So in that case, if they are not related, the Director General will accept receive already, then only tax. Haven't received, don't tax yet. It's not a problem. The problem will only arise when they are related. If they are related, they then can collaborate and say, even small can afford to pay big. They small purposely don't want to pay yet. because if they pay, they know that big will be taxed, so they purposely delay, don't want to pay big, and then forever they delay, and yet here they can claim deduction, here not taxable. That is what happens. So as a result of that, the Director General come up with this section 29(3). If you are related, then obtainable on demand means due to be paid by small. Okay. Related or not related, which YA is taxable is still YA of receivable, because I told you here, this section 27, section 29(1) is applicable to related plus non-related. This is a general rule. We will always tax them. Tax in a YA, it is first receivable. Related or not related is only the definition of obtainable on demand. Okay. Revised count has to be done. You really need to revise your count because your count already submitted without taking in the interest income. External loan to director, no interest charged to director. The company will need to compute deemed interest. We will cover that in a later part. Do we need to write the title for section 4A to 4B? Okay, no need to write. TX you need to, by ATX examiner, so long you put in your com, she will mark you correct one. She doesn't bother whether you put your 4A first, then 4B, 4C, 4D. No need, you can just mix them up. So long you put there as taxable, she will give you marks. But if the interest is due to be paid on 2021, but it was paid in advance on 2020, yes, very good question. Are you all able to see this question? Interest is due to be paid in 2021, but we actually it was paid in advance. So if it is paid in advance, of course, then we start to tax. If it is paid in advance, that means you receive. It's taxable when it's received. When you actually receive it, we definitely have to tax. It's just that you haven't received it, then if you want to tax, we will tax it when it's obtainable on demand. So what is the meaning of obtainable on demand? When the interest is due to be paid by the borrower. We will only use due to be paid by the borrower when the interest is not received yet. That's why we go on the basis of obtainable on demand. So if it is due to be paid in YA 2021, but you actually paid, that means big actually received it in YA 2021, then we don't have to look at the obtainable on demand date. We straight away tax it because it's already received. We will use section 27 straight away. So once received, we will tax the interest income, but of course we will not tax it in YA 221. We will tax it in YA, it is first receivable. So we go back to allocate, let's say your interest income is 100,000. Every year is 10,000 or maybe 60,000. So we will tax first receivable. First receivable is YA 218. We will tax 60,000. YA 218, 219, we tax 40,000. After that, finished. Then we wait for when it's due to be paid the rest of it. Then just now 219, we tax a little bit 40. You still have 20 not taxed yet. Then this is taxable when it first receivable. The next first receivable year will be 219. Then we follow the earliest year. That's why you have to work that first receivable. That means cash basis or due to be paid, whichever is earlier. You are right, whichever is earlier. if little fails to pay the interest, big will deem to receive the interest income. Yes. Now, this question, they give you the due to be paid date. If big and small are very nasty, they will tell Director General, small cannot afford to pay at all. So because it's making loss, there's no money to pay. If you force small to pay, okay, and say it's obtainable on demand and force small to fix the date that is due to be paid, small will go bankrupt. Small actually got no money to pay. Director General won't bother one enough. So if that happens, then they will apply another section, and I can't remember the exact section now, but it's also under section 29. Then it could be 29 for Director General. In that case, if you cannot fix your due and due to be paid date, they will assume that this interest is obtainable on demand in the following YA. So it's receivable in YA 217. In Y218, right? If you cannot give the due to be paid date to the Director General, they will just deem it to be obtainable on demand in YA2019. Well, still, next year already have to recognize as income. So you either give a due to be paid date to the DG, or you don't want, then they fix it for you. It's even a nearer date. You have to pay tax even faster. So you want to give due to be paid date or not to the Director General, you better give. They wouldn't know, of course, if they haven't audited you. If they audited you, you'll be in trouble. Guys, any problem or not? So actually, Shahidan, sorry. She is actually asking the question is on cash basis or due to be paid, whichever is earlier. I mentioned that we use cash basis is because Section 27 say is taxable when it's received. That's the first section say that the interest is taxable when it's received. So that's what she means by cash basis. The problem is you don't receive it, then what happens? Then we will treat as received when the lender is able to obtain a receipt on demand. So when the interest is obtainable on demand, it's considered as received. This rule will only come in if it's actually not received. If it is received, they got problem. No problem, don't need to use Section 29. If it's received straight away, you use Section 27. If it is not received only, we will use the rule of obtainable on demand. Obtainable on demand will not be a problem also until is a transaction between related parties where they will delay the obtainable on demand date. Then the Section 29.3 will come up with the date to say that the year that the interest is due to be paid by the borrower, and that's when it's considered as obtainable on demand. Then both parties, lender have to take it up as interest income. The borrower has to take it up as interest expense. In what year? In a year is receivable for lender, in a year is payable for the borrower. Okay? All this coming because related party. But if you refuse to give due to be paid date, then what happens? Then is obtainable on demand in the following YA. But still, is even an earlier date. ESR we cover later. Guys, can we talk about this topic? Okay, now donation is 10% already. Under budget 2020, all the donations, the deduction is restricted to 10% of aggregate income, whether it's individual, whether it's company, whether it's trust, or any taxable person you can fund from the act, is all 10% of aggregate income. Is no longer 7%. That is not even budget 2021, that's budget 2020. Okay, guys? Secretarial and tax fee deductible up to 15,000. Combine 15,000. The Act says combine 15,000. So you cannot ask me how much secretarial fee alone, cannot, because the Act says combine 50,000. Last time it was secretarial fee alone, then tax fee 10,000, secretarial fee 5,000. Now no, combine 15,000. Now obtainable on demand following year only apply to loan. Obtainable on demand in the following year is not just applicable to interest only, it's also applicable to many other income, but the main income we focus on is interest. I cannot imagine rental income is also like that, but I cannot imagine the examiner will examine for the purpose of anti-avoidance for other income. A very common income that people use to avoid tax is interest income. Okay, good. Now I haven't finished. Let me finish the question. Now we finished big already. Now we need to talk about small. Small have to claim what? Small have to claim deduction. When do you claim deduction? So we do not want to have a mismatch here, deductible, here not taxable. We want here to be taxable, here to be deductible. Okay. So when is it deductible? Same. In a YA that the interest is due to be paid by small, then you can start to claim deduction. But deductible in a YA, it is payable. Same. So let's look at small. Small, the interest expense is deductible. Why? Because the interest expense is employed in production of income, that's why it's deductible. We know deductible, but what year, the timing, we look at section 29. Okay, whether deductible or not, we look at section 33(1)(a). Now, interest expense deductible for little when it's due to be paid. That is YA 221. 221 only start to claim deduction, but deductible in the YA, it is payable. So interest is payable from what YA to YA what? 218 to 2021. So also need to revise comp. Just now that one big revise comp, small also revise comp. Now, if small wants to revise comp, have to notify the Director General. So you notify within 12 months from end of the basis period where interest is due to be paid. End of the basis period. Interest is due to be paid. Interest is due to be paid is 2021, right? Basis period means year end or means calendar year? Tell me. Basis period means year end or calendar year? It means year end. What is the year end of the company for YA 2021 when the interest is due to be paid? What is the year end of the company? 30th of June 2021. Correct? That's the year end of the company. They say 12 months from end of the basis period. I add 12 months. So that will be 30th of June 2022, right? Okay. So for this, you need to revise your tax com, inform Director General. Which years you need to revise? Do you need to revise YA 2021 com? Now is 2021. Do you need to revise YA 2021 com? 2021, you haven't even submitted your YA 2021 return yet. Most of the time you haven't. 30th of June, 30th of June 2021. When do you submit your Form C? You add 7 months. You submit your Form C. So 7 months from here is what date? Tell me. 7 months from 30th of June 2021 is what date? What date is that? Yes, it's 31st January 2022. So when it's due to be paid, the time when you know that it's due to be paid in 2021, you haven't even submitted your Form C for YA 2021 yet. Is there a need to revise the comp? There's no need to revise comp because you haven't submitted income tax return form yet. So what you do is just claim deduction for the YA 2022 claim deduction in the income tax return form in the YA 2022 when it's submitted later on 31st January 2022. But those that you need to revise comp will be YA 2018 to 2020 that you have submitted your income tax return form without claiming deduction. Now you need to revise the comp. Claim deduction. When you claim deduction, then do you need to pay more tax or pay lesser tax when you claim deduction in those years? You pay more tax or lesser tax, you pay lesser tax. When you pay lesser tax, then the assessment will be reduced. So it is involving reduction of assessment. So it's important you need to notify Director General. So if they need to issue reduced assessment, that means they have to give you refund. So they are very particular, you need to notify them. All right. Is it related to 85%? No, not 85%. That one is giving estimates, nothing to do with that. Is this interest deduction method the same for both related and non-related? Now, non-related, I don't have to look at due to be paid. I don't have to bother about due to be paid. But related only, you see, is the same lah. It's the same that you need to revise I know what you mean. You're asking me whether non-related also have to revise is it? Suzanne, are you asking me? Prescribed form instead of form C if I forgot what form. Can. You can use prescribed form. Yes. Suzanne is the same whether you are related or non-related. So like non-related, you receive the that means small word. Non-related is different. Non-related is different when it comes to the borrower. When we do a tax com, if you are non-related, you will see an interest expense in the SOPL. You don't bother whether it's due to be paid or not. So long it's charged to SOPL, you accrue for it lah. So it is based on the loan agreement. The loan agreement say every year you're supposed to pay 10%. Then you charge to SOPL 10%. You claim deduction based on that. That is non-related. Suzanne, that's non-related. As and when is payable, you will claim deduction. So it's different for borrower. We don't have such problem. It's only the related we have. Okay, can I consider finish this topic? I need to go to the next topic. Or I need to give you a break. Do I need to give you a break? Okay, I give you a break. I give you a 10 minutes break, okay? I no need break. I don't know whether you all break down. Break. I give a 10 minutes break, okay? Okay. 10 minutes or not 10 minutes will do.
I think Miss Kok needs the break more than any of us.
Okay. So we take a 10 minutes break. Thank you. Okay, guys, welcome back. Can you hear me or not? If you can, please type yes in the chat box. Thank you. All right. I want to clarify because I see students post into the Q&A box the questions, the tax treatment between related or non-related parties. I want to clarify again. Are you all able to see the questions in the chat box as well? Are you all able to see the question in the chat box? Only I can see. So everybody can see. Good. Okay, good. So let me clarify now. Non-related. If I'm talking about non-related company, so this company A give loan to company B. So this company B will pay interest. To this company B is interest expense. The interest expense that is charged to SOPL is per loan agreement. So then we definitely in the SOPL, we will accrue for this interest expense, even though if it is not paid by company B. But they are not related. So company A will chase for payment of the interest expense from company B. So unless company B really cannot pay, then only they can delay the payment. If like, for example, they really got a cash flow problem, then they will delay. If not, definitely company A will chase company B for the payment. So in that case, the Director General feels is okay. So this interest expense will be deductible. So we just make sure you satisfy the condition for section 33(1)(a). Timing of deduction will be, let's say, 10% of the loan every year. You owe people's money, you have to pay one. No choice. You're not related, you know. They will not let you delay. You delay, they take you to the court. So delay, they take you to court. So it's actually obtainable on demand already. So they don't even need to define the word obtainable in demand. They will know that company A will chase for the interest expense. For company A, it will try its best to chase for the interest income because they're not related. So here, the interest income, of course, will be taxed as Section 4C income. Tax only when it's received. As I told you, no need, receive also means obtainable on demand. But the Director General is not going to argue what is the meaning of obtainable on demand because they know they are not related. Company A will take legal action against company B if they refuse to pay the interest expense. So when received, brought to tax. Tax in YA of receivable. Here will be deductible in YA of payable. Are you able to understand this? Type yes if you can. Are you able to understand a non-related parties transaction? This is like a normal transactions that you audit, that you prepare your com, is based on this method. Okay. But this method will not be applicable to the related parties. If it is applicable to the related parties, then it's subject to manipulation. Why do I say so? Because if I allow company B, Director General allow company B to claim deduction in YA of payable, so no problem for a related company. What they do is they just sign an agreement with company A and then put in an agreement, company B is supposed to pay interest 10% every year to company A, and then they claim deduction in YA of payable. But when it comes to company A, the act said, you will only bring your income to tax when it's received. So then company A tells company B, don't pay me, you pay me, then the interest income become taxable. So don't pay me. And yet when company B don't pay company A, they are able to get deduction when in the YA of payable. So here you have a scenario where it is deductible. You have a scenario here is you don't pay, you don't get paid, it's not taxable. So this arrangement will normally be carried out by those related parties that they give on their intercompany loan. So that's why, because the Director General knows that they will manipulate, so they come up with a definition of the meaning of obtainable on demand. So here, when it's taxable in a YA of taxable, when it's brought to tax when it's received. Received here doesn't mean that you really receive cash only, is only then you'll be brought to tax. When it's obtainable on demand, already means that it can be brought to tax. Now, this is also a normal rule for non-related party. Obtainable on demand already can brought to tax. It's just that for non-related party, no problem. Obtainable on demand and received that is always almost the same thing. Okay, we don't dispute on that. But when it comes to related parties, obtainable on demand, the Director General has to be more specific. They say it means when it's due to be paid by company B. And the same thing here, you will claim deduction when it's also due to be paid. So as a result, this will stop the company to make an arrangement where company B can get a deduction, and yet company A is not taxable, because both the timing to bring company A to tax, bring the lender to tax on the interest income is based on when it's due to be paid by company B, then company A must bring the interest income to tax. When it's due to be paid by company B, then the interest expense will be eligible for deduction, but deductible in a way of payable. Here, brought to tax when it's due to be paid, but taxable in a way of receivable. So when here get deduction, here will be taxable. It match. That's the purpose of this section. Can you understand or not? If you can understand, can you please type yes in the chat box for me? Secretarial fee and tax fee, we combine, we can get deduction up to 15,000 combined. Combined, that means if I will have a secretarial fee of let's say 8,000, then I have tax fee 16,000. In total, I get 24,000. So my maximum deduction will be 15,000. That's all. All right. But if I have zero, let's say I will have zero tax fee, I only have secretarial fee. My maximum deduction will be 15,000. So in that case, my deduction is only 8,000. Can understand or not? Okay. Good. Now we finished this. Let me continue on with my notes. Otherwise, I can only finish the examiner's article. I think I can only finish examiner's article. Okay, no choice. All right, we now continue on with ESR. Just now, some of you were talking about ESR. So now that's why I'm doing ESR. It's actually covered by the examiner's article. Can we have a webinar on Sunday? Ayo. I don't know, like it's OT, right?
I'm afraid we can't have another session on Sunday. I'm so sorry.
You all gave me a fright. You know, like Joanne, she was quiet for so long. Suddenly, she also say something. Never mind. Okay, next time you won't see me anymore because you would have passed already. So the next round, if there's any, maybe in future we'll have some webinars some more. Okay. Okay, now let's look at ESR. We look at ESR. Now, this ESR, just now I mentioned to you that, hold on, this ESR. Just now we have this section 33(1)(a). Okay. So what is section 33(1)(a) says? Section 33(1)(a) says you get a loan. You want to know whether your interest expense is deductible or not. That depends on how the loan is being used. If the loan is employed in production of income, then your interest expense is deductible. If the loan is laid out on asset, maybe the loan is used to buy factories, used to buy maybe plant and machineries, or then these assets are used for production of business income, your interest expense will be deductible. So we claim interest expense deduction. But the Director General also noticed that there are companies who can actually afford to buy all their plant and machineries, all the factory with cash. Right? They are so rich they can buy with cash. But if they buy with cash, then they will not have an interest expense in the SOPL, cannot claim deduction. So even if they are cash rich also, you will find that they will purposely get loan to buy all these assets or to pay for the business expense so that they can get deduction on interest expense. And sometimes this loan, they didn't get it from the bank. They get it from their associated companies. And sometimes when they get it from the associated companies, they don't even get from associated companies in Malaysia. They get the loan from associated companies in overseas. Why? Because let's say this is a Malaysian company. They get a loan from an associated company in overseas. So they pay interest expense. Malaysia tax rate is considered as low or high. Malaysian tax rate is considered as low or high. Malaysian tax rate is low or high. Malaysia, oh, thank you so much. Okay, Malaysian tax rate is low or high. This is considered as high. High, high. The first 600,000 is taxed at 17%. That one cheating one. It's only 600,000 taxed at 17%. The excess of the chargeable income is 24%. What is that 600,000 taxed at 17%? It's only on 600,000. So typical of our finance minister. You want is make it a wider range of the chargeable income tax at 60%. I know pandemic time we are not rich, but we're not genuine. So we are not competitive, not tax competitive compared to other countries. Even in our region, Indonesia is already 15%. Singapore about 16 point something percent. Hong Kong 16 point something percent. You go to Labuan also very stingy already now. Only certain activities you can get 3%. Otherwise, Labuan, the tax treatment is also like only certain activities you can get 3% only. Those prescribed activities. If not, you'll be taxed on the normal rate. So what for? So we are getting very stingy, 24%. So Malaysian company, you pay interest expense to an associated company in Malaysia. When you pay interest expense, this interest expense is deductible one. Deductible interest expense on this side, it becomes taxable. I claim as much deduction as possible. My profit goes down. I want it to go down because the tax rate is very high in Malaysia. It's 24%. I can actually ignore the 70% on 600,000. Okay. Now, or maybe you can calculate effective tax rate. You take the average of the two rate. Here, on the associated company in overseas, maybe this associated company is in a tax haven. Let's say it's in Bahamas. Maybe not need to go so far. We just go to Singapore. It's about 16% only. So you don't mind having to receive an interest income, which is high. So in a way, you're shifting profits From which direction to which direction? When a Malaysian company is claiming deduction on interest expense, here we receive the interest income and tax at 16%, here deductible at 24%. We are actually shifting profit from Malaysia to Singapore. We don't want to have this shift of profit to happen because it results in leakage of tax to Malaysian tax authority. We want to tax. We don't want Singapore to tax. We want to tax it. So we know that there are companies that make arrangement in such a way that actually they don't need to have the loan, but they purposely get more loan from the associated companies in overseas where they will try to claim more deductible expense, okay, so that they can shift the profit to their associated companies in overseas, especially in a country where they have lower tax rate. So for the company in the group, they're able to lower tax like that. So even if the interest expense can satisfy the condition of Section 33(1)(a), it's supposed to be deductible. They want to restrict the deduction further. Okay, so how to restrict the deduction further? Let's look at this Section 140C, ESR. Now, this is only applicable. The Director General can only restrict the deduction on the interest expense when the person or the company, okay, has got business income and you're trying to get your interest expense deductible from your business income. If you're trying to get interest expense deductible against a non-business income, interest expense deductible against an interest income, that one don't have Section 140C interest restriction one, don't have. This one is you're trying to get your interest expense deductible against your business source. Your interest expense is actually related to a loan or financial assistance in a controlled transactions. What is the meaning of controlled transactions? That means your loan is obtained from related parties. What is the definition of related parties? Here you need to be careful of it. Okay, related parties means one person has control over the other. So if it is control, if I say more than 50% shareholding in the other, definitely got control. Anybody also know more than 50% got control. Okay. Now that means I will have the lender control over the borrower or borrower control over the lender. Or both borrower and lender are controlled by same person, more than 50%. Now, it used to be more than 50%. More than 50%, very hard to catch them. They will still manipulate if it's based on 50%. So what they do is just they reduce their shareholding to less than 50%, then you cannot catch them anymore. All these associated companies, you can have shareholding below 50% and yet they are related. So the Director General is also very smart. Now they didn't mention more than 50% anymore. If it is 20% to 50%, they are still considered as related so long one party has proprietary rights that the other party relies on. So what I mean is I have company A, okay? I have company B here. Company A has only maybe 25% of the shareholding in company B, okay? So it's less than 50%. It doesn't look like control, but company A has got maybe a patent, and this patent is a certain secret process that company A allows company B to use, and the company A is the owner of this patent. So company B has to use the patent and then pay royalty to company B. So company B actually relies on the patent that is owned by company A, as well as company A has got more than 20% shareholding in company B. Okay, so these two combined, the shareholding is not more than 50%, it's 20 to 50%. But with the ownership of the patent, which company B relies on it, company A actually controls company B. So there is a word "and" here. Now, so if it is more than 50%, you don't have to look at whether they have proprietary rights or not. No need, that one very clear already controlled. Now, then one party has business activities with the other party. For example, company A has got 25% shareholding in company B only. But then company A supply raw material to company B. So that company B rely on the raw material for production one. So without this raw material, company B cannot survive. So with the 25% shareholding plus the supply of raw material to company B, company A actually control company B, although it does not have more than 50% shareholding. All right. We hope like yes, I will come up. Now, company A has got 25% shareholding in company B, plus it can appoint one director in company B. One director cukup. Now, when it is service tax, they have this group relief. That one also mentioned more than 20%, but the directors that they need to appoint is majority of the directors for group relief to check whether the intra-group services can be exempted from service tax or not. Intra-group services between the group companies, the shareholding has to be more than 20%, plus the company must be able to appoint majority of the board of the majority members of the board of directors. One not enough. This one cukup already. Okay. So yes, satu cukup. Then the SST is majority. So this one very lenient. You can easily become associated, easily caught by ESR. So they want to catch you. All right. Good. So now, how come my sharing is paused? Hold on for a while. Let me check. My sharing is paused. Okay. Good. So now, we want to know how are they going to restrict? If they can find that your interest expense, they want to claim deduction against a business source from a loan in a controlled transaction, you are able to prove that there is controlled transaction. So how did they restrict the deduction of this interest expense even though it satisfies this condition? So the interest expense, which is more than 20% of the EBITDA, the excess was to be added back, not deductible. So your next question is what? Ask me question. What is your next question you should ask when I tell you this? What is the next question you should ask when I tell you this? That the amount deductible, the amount that is not deductible will be the amount that is more than 20% of tax EBITDA. The excess amount is not deductible. Okay, what's the next question you need to ask me? What is EBITDA? You're right. What is EBITDA? So, what is EBITDA? So the EBITDA is different from the accounting EBITDA, okay? Our tax EBITDA means your adjusted income. Your adjusted income, you add back your double deduction. You add back your interest expense under section 140C. That is my adjusted income. Earning. So you will, for accounting, you will say is earning before. For accounting, you will say is earnings before interest, before tax, before depreciation and amortization. That's not the meaning of EBITDA for tax purposes. The meaning of EBITDA is A is easy. Is A, B, C. A plus B plus C. What is A? Adjusted income. What is B? Add back the double deduction that you claim in adjusted income. What is C? Whatever interest expense you claim deduction here, you add back here. Okay, that is called adjusted. That is called tax EBITDA. So it has a different meaning. So you don't simply say it's actually earning before interest, tax, depreciation, amortization. Okay, the excess can be carried forward, right? It can be carried forward. Come, let us look at this. So I will have this adjusted income. Let us try to find EBITDA. I'll add back to arrive at adjusted income. The company has already minus double deduction. I need to add back the double deduction. They already minus the interest expense of control transaction. I need to add back. After adding back, this is called A. This is B. This is C. This is called EBITDA. So 20% of EBITDA is 124. Is the maximum amount of interest on controlled transaction should be deductible. The interest expense on controlled deduction is 500 the maximum amount deductible is 1 to 4. That means you can only claim deduction 1 to 4. How much to be added back? Will be 500 minus 1 to 4. That amount is to be added back. Are you able to understand or not, guys? Are you able to understand? Okay, good. 376. Yes, it can be carried forward. It can be carried forward. Carry forward to next year, then you try to claim deduction for next year. But of course, next year it will be subject to 20% of next year's EBITDA. It cannot be more than that. So it's again subject to the conditions of next year. Okay. Now only you learn EBITDA 3 days before exam. Never mind. So long you understand, then you'll be able to handle your exam question. Now, if it comes out, it will not be difficult because it's the first sitting, and ESR is something so new. In practice, also, it's like not many people have been like subject to ESR yet. So even if it comes out, it will not be complicated. So you should pray that it comes out, understand or not. Okay. Now I will have a negative adjusted income. I have a negative adjusted income. I add back my double deduction. I add back my interest on controlled transaction. I will get a negative figure of negative 140. Okay. I will have an adjusted loss. Now, EBITDA, I'm supposed to take 20% of EBITDA. It's very illogical if I take negative 140 times 20%. Then I get a negative figure. Negative figure, I cannot even interpret it. No? So the EBITDA, it cannot be a negative figure. The EBITDA, the lowest, has to be only 0. Cannot be negative. So if it is, you have an adjusted loss, you put 0. 20% of 0 is 0. That means this interest expense, the maximum deductible amount that this company can claim on the interest on controlled transaction from associated companies from overseas. If the associated company is in Malaysia, there's no ESR. It's only for associated companies in overseas that give loans to Malaysian company. Then you want to try to get your interest expense deductible. You want to overclaim, then cannot. They will not allow you to claim deduction more than 20% of EBITDA, which is 0. So now I can claim deduction 0 only. How much to be added back? 50 minus 0. This amount to be added back. Okay? So I can carry forward this 50 to next year. Then next year, you'll be subject to the condition of 20% of next year's EBITDA. And so on. Okay, guys? Can? Good. Now, let us read this question. This part. Explain with reasons whether the interest cost incurred by little on loan to finance the construction of the buildings qualify for tax deduction, whether there's any further restriction on the deductibility. This one is not a past year. This one I create one, the question I create one. So if you go into the exam hall, you see a question like this. Wow, hit lottery. I tell you, I don't know what is it. You don't know me, also you must come and find me. Take me out for a meal, understand or not? Okay. Now, okay, let me see any question. So everybody take me out for one day. I think for the rest of the year, I don't have to pay for my lunch. My lunch will be free. So many of y'all. How many of y'all? 485, wow, everyday lunch free. So nice. Okay, let me see. Must pass. Yes, must pass. Inilah kalinya. Whatever is it, never give up. I fail my ACCA so many times. I don't give up. I never regret not giving up. If I give up, I think today I sit down, I think of it, I will regret. Okay, let's look at this. Little plan to construct 2 factories and 2 warehouses. Oh, very rich. This little is very rich, although the name is called little. Okay, want to build 2 factories, 2 warehouses to expand the manufacturing business. So let me ask you, just now you have learned the interest that Little has to pay if Little were to finance the construction of the 2 factories and 2 warehouses by getting a loan. Is the interest on the loan deductible or not under Section 33(1)(a)? Is it deductible? If it is deductible, under which reasons is it deductible? 1 or 2? Is it 1 or 2? Yes, it's layout on asset. Okay? Yes, layout on asset. So it's deductible. But the problem is Little will finance this construction of this building with 50 million from Giant. Giant is a foreign company. And then 20 million from a commercial bank. So let me draw out the scenario for you at page 24. At page 24, so you will have Little gets the loan from Giant. Little also gets the loan from a Malaysian bank. From Giant is 20 million loan. From a Malaysian bank, sorry, this is 50. This is 50. And from Malaysian bank is 20 million loan. Of course, there's no free lunch. I also don't expect free lunch from y'all. So the interest, then you have to, Little has to pay interest to the Malaysian bank, has to pay interest to Giant. Let us see what is the interest expense. The annual interest on the loan is 10%. So that's 10%. So the interest is 10%. This interest is 10%. Layout on asset and employed on employed must be separate. These are the Section 13(1)(a) income. They give these 2 objectives of the loan, and then the interest will be deductible. It should be separate. It should be separate. Okay. So now, after that, this one got no TP issue. Why? Because you are getting it from a third party. This is a Malaysian bank. This one, is that TP issue also? No TP issue also. Why? Let us see. Let us see what is the relationship of Giant and Little. Let's read. Now, Giant has got 25% shareholding in Little, so it's lesser than 51%. With the 25% shareholding, Giant has the right to appoint a director to represent itself in the board of Little. So, is Giant and Little, are they related or not? Are they associated or not? They are associated. So this one, they are associated. Yes, because 25% shareholding plus appoint 1 director. 1 director cukup. So this is associated with Little. All right. So is there any TP issue? The question is not asking on TP. The question is asking on whether the interest deductible or not. Is there any further restriction? So there's no TP issue. Why no TP issue? Although this is transaction between associated parties, why I say there is no TP issue? TP issue is arise from interco transaction. This interco transaction, TP issue is what Rachel say is to trap associated companies not transacting at arm's length price. This is transaction between associated company, but is the interest rate arm's length price or not? Tell me. Interest rate, is it arm's length interest rate? Tell me. Yes, it is. How do I know? Because I compare with the interest rate that the Malaysian bank charge they charge 10%, so Giant charge 10% is already the arm's length price. That's why there's no TP issue. So no TP issue, so the Director General will not say they want to impose arm's length price. So now is deductible under Section 33(1)(a). Is there any further deduction? Yes, there is further deduction. Why? This is loan transaction. This is a loan transaction. They are getting interest. Little is paying interest on the financial assistance that is given by an associated companies in a controlled transactions, right? So then the deduction of the interest expense should not be more than 20% of the EBITDA. Let's look at whether we are given the EBITDA figure or not. The adjusted income of Little is 8 million after deduction of interest expense. So I need to find the interest expense. So adjusted income is 8 million. So my EBITDA is adjusted income at my double deduction at my Section 140C interest expense. So my adjusted income is actually 8 million. There's no double deduction, so actually in your answer you don't need to mention double deduction because it won't have. So your principal here no need to mention double deduction. Your interest expense here, do we need to add back this 10% of 20 million, or we only add back 10% of 50 million? Which one do we need to add back? 10% of 50 million or 10% of 20 million? Or is it 10% of 20 plus 50? Which one? No, it's not both. It's not both. It's only 50 million. So it's only the controlled transaction. This one, so that will be 10% of 50 million. That's 5 million. So my EBITDA is 13 million. So the 20% of 13 million, okay? This is 2.6 million. How much is the amount that is Little try to claim deduction on the interest on this controlled transaction? Is 5 million. So can you get deduction up to 5 million? Cannot. You can get deduction only up to 2.6 million. What happens to the excess? The excess is 2.4 million. We carry forward to subsequent years. Is subject to the maximum of interest allowable for that year. So of course, subject to the 20% of EBITDA of that year. We can only carry forward. Not every company can carry forward. You carry forward only if you find that the shareholders on the first day and last day of the basis period of the following YA is actually substantially the same. Substantially means more than 50%. Okay. So let's read the answer. Now, in total, it's 70 million. 50 plus 20 is 70 million. In total, the loan is 70 million. It qualifies for deduction under Section 33(1)(a). Why? Because the loan is laid out on asset, which is factory or warehouse, which is used for production of gross income from the manufacturing business. But even though it's deductible under Section 33(1)(a), the interest will be further restricted on which part of interest? Those interest that is related to a loan in a controlled transaction, which is more than 20% of EBITDA. So we have to look at the interest. This one got no ESR one. Why? Because this loan is gotten from a Malaysian bank, which is not associated company. Even if it's associated company, if associated company in Malaysia, there's no ESR. So this 2 million is from Malaysian commercial bank. It's not subject to any Section 140C interest restriction. It's only the 50 million from the Giant, which is an associated company outside Malaysia, is subject to interest restriction. Why? Because Giant is associated company of Little. Why I say so? It owns at least 20% of the shareholding. In this case, it's 25%. Has the right to appoint one director. So then you explain the rest. Is more than 20%. You understand, guys? You need to be ready for ESR just in case it comes up. Any question? ESR only applicable when there's a financial institution for foreign company. Yes, associated company from overseas. And I forgot to mention that ESR here, ESR does not apply to individual. If there is no ESR, if your interest is actually 500,000 or below, it's too little already. So they will not bother to impose interest restriction on this amount. Guys, any more questions? Don't have, then I move on to the, it took 5:21 already, Oh dear. We're supposed to stop at 5:30, okay? Loan to directors deemed interest. Let me cover this, and then after that, that's it lah. So I covered this, and then we call it a day, okay, guys? Loan to directors deemed interest. Now, just now I actually gave you the link, right? This link. This is on tax planning. It's a quiz. Even though it's MCQ, I actually extracted the scenario from the past year. So you try to answer the question. It will prompt you. Tax planning will always come out. It will prompt you. You can think about it. I think it's good to try the question. It's not long. It will not take a long time. The question very short MCQ. How long can it be? So try it out. Fill up the form. Try it out. Okay. If you want to have the answer to the quiz, you want to have the answer and the question, just answer the details. The links for the attendance. You need a code. Is that you're supposed to get a? Do they ask for code? Do they ask for code? No need. I think no need. Just click inside. No need one. No need. Just you answer. They ask you whether you want business or personal. Just click personal and then move back. Move back. No need a code. Just go back to the link that is given in the form. Click the link. You can go in. You need a code. Let me see. Let me see whether I have the code or not. Okay. Just in case you need the code, then I give you the code. Join with Google accounts, then you probably don't need code. Now, I give you code here. Okay, guys. We come back to here. Please do the quiz. It will help you. We are doing this last topic. Now we have a company. Give loan to director. This one is a director of a control company. The meaning of director here is this director has a shareholding of 20%. And is a director of a control company. We're not talking about listed company. We're talking about small company. So, if the company is very small, the director and the company, the director will treat the company belongs to him. The director is also normally a shareholder. So, and then this director will make the company give loan to him. Then the director, because the director will feel that company, it actually belongs to him. The company is his. So most of the time, he will not pay interest back to the company. And interest will not be paid. So it's interest-free loan to the director. Now, in that case, we will say the interest will only be taxable on the company when it's received. But there's no interest to be received by the director. So in that case, how? Now, then the inner revenue come up with this section is section 1 for OB. You have a company that come from giving loan to the director. This loan is from internal fund of the company. So the loan must come from internal fund of the company. Number 2, it must be given to a director. Definition of director important. It must have 20% shares in a company. Then the loan from director must come from internal fund. Internal fund means the loan come from share capital, come from retained earnings from reserve. Okay. Then in that case, this company will deem to earn an interest from the director. So there will be the loan that the company gives to the director, there will be a deemed interest. Interest is deemed received from the director by the company. So then this interest income will be taxed on the company as section 4C income. Now, if the loan is from the bank or from a loan from outsider, then there will be no deemed interest. The deemed interest will only be applicable. That means the company is only deemed to receive interest from the director if the loan given to director come from internal fund, plus this director has got shareholding of 20% in the company. All right, guys? Good. So we continue. Now, how do I calculate the deemed taxable interest on the company? This is higher off. Half of the outstanding loan, not half, 1/12 of the outstanding loan times the ALR rate, compared with interest charged by the company. So if the interest charged by a company is 0, or maybe 1% they charge interest on the director, so little, the ALR rate will be the Bank Negara interest rate. This is per annum. Divide by 12, so that means you will get the interest per month times the outstanding loan. So interest per month, interest rate per month. We interpret the formula in interest rate per month times the outstanding loan. I will get my interest rate, interest expense. Sorry, it's an interest income. Based on the Bank Negara rate, compared with the interest charged by the company, whichever is higher will be taxed on this company that gives loan to the director. So again, is anti-avoidance. Okay, they don't want the company to give loan to director, and then the director will tell the company, is interest free or charge very low interest. So at the end of the day, this company doesn't need to report tax on the interest income on the correct amount. You avoid tax. They will make a deemed interest to be taxed on the company based on this formula. It has to be higher off. If it's low off, it cannot be anti-avoidance anymore. Very illogical already. Okay, so let's look at this question. We have Sri Kaya make up accounts to 31st December annually. Wait. Joanne.
Yes, Ms. Kok.
Joanne, can I finish up to question 9 before I call it a day?
Yeah.
Can I extend a bit, Joanne?
If the students are okay with that, I'm perfectly fine with that.
Okay, so sorry.
No problem, as long as the students are all right.
Okay, they say okay.
Yeah.
So for midnight also can. Oh my god. Okay. Thank you, guys. Okay, because suddenly I realized there's something new here that I need to talk about. This is something very new. So let me finish this first. Okay, deemed interest. Now, so since Joanne allows me to extend my time, then I don't have to rush, so that you can understand. So I have Sri Kaya here. This Sri Kaya give interest-free loan to 3 directors. Although the name of directors but it may not fall under the definition of directors under Section 1 for OB. Okay, not all the directors will fall under the definition. If the directors do not fall under the definition of this Section 1 for OB, then there is no deemed interest on the company. Let's look at the first director. So-called director is a chairman. The name is a chairman. It does not matter what is the name. Now he has got how many percent shareholding? He has got 52% shareholding. So number one, he has got 52% shareholding. So 52% shareholding. This is more than 20%. Sorry, I should put here 52%. This is more than 20%. So as a result, he will be a director. This is a director. Who is the name of this employee? The employee is called chairman. Let me ask you, is a director an employee of the company? Is director an employee of the company or not? Is director an employee of the company? Yes, director is an employee of the company. Okay, so they would have employment income. So now the next thing is I want to know whether employer Sri Kaya will have deemed interest will depend on what is the loan given is 800,000. The 800,000 sourced from where? Is it from internal fund or from external? From internal fund, then there will be deemed interest. It's from internal fund. So this is from internal fund. So the shareholding is 20%. He's a director. This is from internal fund. So this employer will have a deemed interest in this case. So there will be deemed interest. Is the ALR rate given to me? Yes, the ALR rate is given to me. It's actually 6% ALR rate. Okay, so this is 6%. 6% times the loan. How much is the loan? The loan is 800,000. So 6% times 800,000. So the deemed interest on the employer, which is Sri Kaya, the amount taxable as Section 4C income is 48,000. Satisfy the two conditions. Let me fill up the figure here. Let me fill up the figure here at the bottom. So sorry. At the bottom, where did my, yeah. Okay, here. So chairman owns 52% of the ordinary shares. That's more than 20% of the share capital. So this 800,000 is from internal fund. As a result, Sri Kaya deemed to derive interest income at the higher of the interest charged for Sri Kaya is 0%. Interest charged on the ALR rate is 6%. So the higher amount, 6%, is then taxable in which YA? Let us see which YA it is. This is 2021, right? So in YA 2021. So this will be taxed as Section 4C income, not business income. Why? Because Sri Kaya does not have a money lending license or debentures and mortgage is not the stock in trade. We will not tax it as 4A income. Okay, next one. Let's see. Now, you notice that we tax the employer. This is I. We tax the employer. What about employee? Is this chairman taxable or not on the interest expense? The employer give him loan of 800,000. Didn't charge him any interest on this loan. So he has a benefit of getting a loan without the need to pay interest. This will be his benefit. Will it be taxable on him? Now the formula to tax him as an employee, so we tax him as a director or as a chairman or as an employee, same. The employer, if it has to pay interest to the bank, Here, no need to pay interest to the bank. The amount of interest paid to the bank is 0% because the money comes from internal fund. Less the amount paid by this chairman to the employee, also 0%. As a result, you find that there's nothing paid by the employer to the bank on behalf of the employee. So nothing is taxable on this chairman. You probably will not be able to see now. Later when you reach this, the third scenario, you'll be able to see better. As long as it's internal fund, and then the employer give the loan to a director who owns 20% shareholding, then there will be deemed interest on the employer. Let's do our scenario number 2. Scenario number 2 will be MD 19% only. So it's given to MD 19%. So the employer here, the employee is MD. Managing director 19%. So you realize the designation of the employee not important. Chairman, you don't see the word director, but he owns 52%. So he is a director. Okay? This one, managing director, you see the name director, but his shareholding is 19%, less than 20%. So he's not a director for the purpose of section 140B. Then his loan is 1.8 million. Come from internal fund one. So it actually comes from internal fund. You cannot satisfy condition number 1, but can satisfy condition number 2. Still cannot, there is no deemed interest. Okay? So let us fill up the detail. So it's 0% and 0% here, because they say 0%. Okay, internal fund is 0%. Okay, come, let's fill up the detail. So here, section 140 is not applicable, despite that it actually come from internal fund. Why? Because MD only holds how many percent? 19% of the share, which is not more than 20%. So there is no interest expense incurred by Sri Kaya also in respect of this loan. So there's no deemed interest income for the company. No deemed interest income. Why they say no interest expense? Because no interest expense, they don't pay any interest expense to any bank. It comes from internal fund one. So when they receive the interest income, also no deemed interest, because they don't charge any interest income on the employer. So if they charge, then they will have an interest income, not from the employer. I mean, the employer doesn't receive any interest income from the MD. So if they charge 1%, they will have an interest income 1%, because then it does not fall under section 140B. We don't need to compare with the ALR rate in that case. It will only be treated as 1% if there is an interest charge. All right? Now, then all right, let's look at in the case of employee, how should we tax this MD? Again, if this employer has to pay interest to a bank, that will be the cost to the employee, which it doesn't need to, because it's from internal fund. The amount taxable on the employee will be whatever cost the employer has to pay to the bank on behalf of the employee. In this scenario, the employer doesn't need to pay any interest to the bank on behalf of the employee, because the loan comes from internal fund. Okay? So nothing taxable on the employee, who is the MD. Now, we look at the third scenario. Third one. Third one is, we will have the financial controller. No shareholding at all. And so no shareholding. So this is an FC. Zero shareholding. So is he a director? He's definitely not a director, but he's an employee. Then loan is 500,000. The loan comes from external fund, 6%. So it comes from the bank, for example, 6%. Then this employer give 0% loan to this FC. Okay, is that deemed interest or not? Firstly, not a director. Secondly, this is not from internal fund. Got deemed interest or not? No deemed interest. Okay, so no deemed interest. Our DG have to tax somebody lah. Who will they tax? They will tax the employee. Now you see, if this employee were to get the loan from the bank, employee have to pay 6% interest. Now he's not getting the loan from the bank. Employer will get the loan from the bank on his behalf. In order to finance this loan, to be on lend to the employer has to pay 6% on behalf of this employee amount. If he has to pay back 1%, then we minus 1%. Okay, we are trying to find the net interest that the employer has to bear in order to give the loan to him. That will be the benefit to the employee, and that amount is taxable on behalf of the employee. That means this is the 6% interest rate that the employer have to pay to the bank, because actually the employer is taking a loan on behalf of the employee. So for that, the employer has to pay 6% on behalf of the employee. So this 6%, isn't it a taxable perquisite on the employee? We call it a Section 13(1)(a) income. Are you able to understand or not? So if I say here is 6%, if I say the scenario here is 6%, the employee has to pay back the director 1%. So the amount that is taxable on the employee will be, the employer has to pay to the bank on behalf of him 6%. He pay back the employer 1%. So at the end of the day, the employer has to pay to the bank on behalf of this employee 5%. So that is the amount taxable on behalf of the employee. So we tax the employee, then we don't tax the employer as deemed interest. Here we tax the employer as deemed interest, then we don't tax the employee anymore here, because the money comes from internal fund. It comes from internal fund, then the employer is not paying any net interest to third party on behalf of the employee. Therefore, the employee didn't receive any benefit. There's nothing taxable on the employee. You will not see double tax here. You will not see a scenario where the employer is not taxed on a deemed taxed on a deemed interest, as well as the employee taxed on the interest benefit. Are you able to understand? What if the loan to employee is from internal fund and the company charges interest? There will be a benefit to the employee. No benefit. So if you are talking about Natasha, you're talking about here, the loan to the employee is from internal fund, so it's 0% here. And then the interest paid by director to the employee, let's say is 1%. So the employer pay any interest rate to the bank on behalf of the employee? Nothing, because it's from internal fund. They don't have to bear any cost of interest on behalf of the employee. So there's nothing taxable. You cannot have bracket one. Okay. Employer is deductible interest expense to the bank. Employer is taxable. Whether deductible or not, it's actually Jiahui is actually asked by the examiner. The 6% paid to the bank, is it deductible or not? Okay, good. Since you are brought up, that is actually answered by the examiner exactly what you are asked. We want to know whether the interest that is paid by the employer to the bank, will it be deductible or not? The interest is staff benefits. There are two ways to argue staff benefits, so it becomes deductible to Sri Kaya. Okay. The examiner also accept an alternative answer. Actually, in practice, there are two opinions also. Some people will say you give loan to employees. Giving loan to employees is actually giving staff benefits. So the interest expense is on the loan that is employed in production of income. It should be deductible. But on the other hand, you can argue that the Sri Kaya is not in the business of giving loan. So if it is not in the business of giving loan, when you give loan to your staff, your loan is for non-business purposes. Giving loan is non-business purposes. So the interest expense is not deductible in that case. Okay? So there are two alternative answers. So when it comes to the FC, it becomes a taxable benefit to the FC. Just now, what did I mention here? So this will become Section 13(1)(a) income is a taxable benefit to the FC. So it's the interest-free loan is a taxable benefit from FC. So it's from external fund. So this will be taxable on the FC. Then the rest of it, I think you can read the answer. Forget about the alternative treatment. Let's see here. This is internal fund. Nothing taxable. Forget about the alternative answer. Okay, this one is okay. This alternative answer, I don't really agree with it. Anyway, it's an alternative answer. The answer should be this one. Should be this one, as what I explained just now. All right, guys. Any question? No question. In what situation do you apply ALR divided by 12 and divided by 12 part 1? In what circumstances? We do not need to. You find that in our question here, you do not need to use ALR divided by 12 because all this is a yearly amount. Is a year-end amount. You will use ALR divided by 12 if they give you a monthly loan. You know what I mean or not, some way. They give you money loan. That means, let's say they give loan to the chairman. This 800,000 is loan to the chairman for 1 year. It's for 12 months. So they didn't give you the movement of the loans. Let's say in January, they will give 800,000. And then in February, they reduce it to 200,000. So in March, then it's further increased to maybe 600,000. Okay. Then in April, it's actually 0. Then you need to find the interest rate per month, the ALR rate per month, and every month you compare which one is higher. You take that one, and one whole year, 12 months, how much? This is what we do if they give us the per month basis. Okay, good. So we finished this. It's actually covered by the examiner's article. That's why I brought up this. The last one. After this, then our class will end. Okay. Here. This is budget 2021. I attended the tax budget by BDO. I attended the tax budget by Monash. I attended the tax budget by Deloitte. They all talk about the same example. So you probably get the same question. Hopefully, if it comes up, you probably get the same question also. Something like this. Okay, now let's look at this. There's this TP adjustment. If the Director General finds that the economic substance is different from the fault, then the TP will disregard the structure and then make adjustment on the structure as it thinks fit. This sounds like Section 1401. 1401 is talking about the transaction. This one is talking about the structure. So what economic structure? Hold on. What example of economic structure. Let me see. So let's say, assuming I have this charitable institution. This is an old case law. The old case law, the decision is different. So the charitable institution, when they receive donation, it will be exempt. Donation will be tax exempt. So this charitable institution has got shares, let's say 100% shares in company A. So when company A is very, very profitable, when you are very profitable, then you will pay back your share of your profit to your shareholder. The shareholder is a charitable institution. It's an approved institution. That means we give donation. They don't have to pay tax one. So if you are profitable, you want to share, somebody invests in you, you want to give return on the investment back to your shareholder, which is the charitable institution. What would company A normally pay back to the investor? They pay back what? A dividend. If they pay dividend, dividend is not deductible for company A. So what? Instead of paying dividend, they pay donation. This donation, tax exempt for charitable institution, for this company A, is deductible up to how many percent, tell me? Deductible up to how many percent? Yes, 10% of aggregate income. So the company A is able to get deduction. That means the chargeable income will drop. The tax will also drop. So why would then you find that the is in terms of form is legal one. This company A give donation to a charitable institution. They really take out money and pay to the charitable institutions. It's not against any law for them to pay donation to this charitable institution. And when the charitable institution receive the donation, it should be tax exempt, just like any other donation that receive. They have the status of approved institution, so it should be tax exempt. So the Director General, of course, not happy. Here can get deduction, here not taxable. So that is leakage of collection of tax. So when I look at this, legally, they are what company A and charitable institution, what they're doing is correct. But when we look at the economic substance of it, and we compare with other companies, when you will have an investor, you invest in another company, your return on capital is normally dividend. How come this one don't give dividend one, this one gives donation? So in that case, DG can disregard this whole structure, okay? Make TP adjustment on the structure. They will then ignore the donation, don't want to give deduction on the donation. This is what they can do. Okay, now assuming like a company make a charitable trust. Yeah, like a charitable trust, not necessary all the donation you receive will be tax exempt. You have to apply to make it in approved charitable trust. You got approval, then you can get exemption. No approval, you don't get exemption. Okay, come. So next one is, what if the economic substance and the form actually don't differ? So here is economic substance is actually equal to the legal form. They don't dispute on this. They agree. Our legal form is this method. Economic substance also okay, no problem. But when they compare with outsiders, they find that the controlled transaction actually differ from commercially acceptable transactions. Okay. Then Director General will disregard this structure again. They make TP adjustments. Okay. For example, like just now here, you will have a loan. Let's say you have a loan from parent company, give loan to the subsidiary. This subsidiary also get loan from the bank. And the subsidiary pay to the bank interest expense, assuming interest expense is 8%. When they pay to the parent company, they pay 15% the interest expense. So when the Director General go in audit on the subsidiary company, they find that this subsidiary company is carrying out manufacturing, they buy a lot of factories, they buy a lot of plant and machinery. And then they check with other similar companies. Other similar companies, when they manufacture the same thing, they really have to spend a lot of money on the capital assets. They have to buy factories and plant and machinery. It's very normal. So acceptable one. It's normal also they finance all this investment in a form of loan, acceptable. And then the subsidiary actually sign a loan agreement with the parent company, just like they signed a loan agreement with the bank. So the form and the substance actually is the same. They don't differ. But when the Director General audits someone, they find that, hey, how come this interest expense 8%? This interest expense is 15%. It's actually differ from commercially acceptable transactions. Then in that case, the Director General is given, this is a new section, is called section 1403A. Don't memorize section number. I just give you the number only for fun. I just want to show off that I know there is existence of this section, so you don't have to show off in Excel. Don't ever write the section. If you write section, you write wrong one, they can actually think the whole thing is wrong. So don't ever quote any section. Okay, no need to crack your brain and then go and memorize section number. Your brain should not be for that. Now, so then Director General can disregard this structure and say, okay, now the interest will not be 15%, it should be 8%, and then make the TP adjustment. Okay, now the under section 140A, I think your lecturer have told you before, it's mentioned that whatever we charge must be arm's length price. For transactions between related parties. So if I have an associated company that acquire a property or supply a property or service, which is not arm's length price, then Director General has the right to replace that price with an arm's length price. Director General has a right to replace that price with an arm's length price. That's the power of the Director General. Now, under this budget 2021, Director General is given more power now. Director General can now, if they find that they disregard the structure, they make TP adjustment on the structure to take in the additional income. It's not just that now they have the right to impose a surcharge of not more than 5% on the increase of income or on the reduction of any deduction. Now, what is the meaning of this? Let's look at this example. Now, you have Jolly. Jolly give loan of 1 million to a UK subsidiary. The interest is actually 3%. Now, after an audit, the Director General did a TP adjustment because after audit, they found out that it shouldn't be 3%. Okay, they should be charging 9%. So the TP, after TP, the TP adjustment, interest rate is supposed to be 9%. Now, to Jolly, the director of Jolly said, the directors of Jolly, they're very cool. They find that, okay, the auditors from the transfer pricing department of the Inland Revenue, they say it shouldn't be 9%, it should be 3%. the loan should be the other way around. Correct. Here give loan to UK company. That means Jolly will receive interest income of 3%. Now, the directors are not so concerned because they know that the interest income that they receive from the subsidiary company is supposed to be tax exempt under para 28, schedule 6. So if the director general increase it to 9%, there is an increase of 6%. So the increase in interest income is actually 6% times 1 million. So the 6% on 1 million, okay, that's 60,000, right? Now, if they make this adjustment, anyway, this is going to be tax exempt under para 3 schedule 6. So if they reimpose back 9% and then they say it's incorrect return is 100% of tax undercharge. There's no tax undercharge because this whole 60,000 is tax exempt. So they cannot use section 113 to impose penalty for incorrect return because there's no tax undercharge. As a result, now under this budget 2021, the Director General is given an additional power. Now they don't call it penalty, they just call it a very nice name. It's called a surcharge of not more than 5% of the increased income. This income may not be a taxable income. So long there is an increased income, then the Director General can impose a surcharge of 5%, which means that you have to tell Jolly, you have to advise Jolly, okay? You have to advise the directors the tax consequences of these two issues. One of the issue is this one. So you have to tell them there may be a surcharge now. Maximum is 5%. It can be any amount, any percentage, but up to 5% times 60,000. There will be a surcharge of 3,000. Even though the income is tax exempt under para 28 schedule 6, they can still impose the surcharge of 5%. Okay. Now another issue that scared everybody under TP now is your TP documents. You're supposed to finish within 14 days from the date of request. If you don't finish within 14 days, if the Director General comes for audit, they ask you to give them the TP documents within 14 days from date of request. We are not able to produce within 14 days. So what is the tax consequences because this company never update the TP documents when? You're supposed to update the TP documents regularly, but they never update the TP documents. So when Director General say, okay, submit your TP documents within 14 days, they cannot produce it. What will be the tax consequences? And the tax consequences, now everybody industry is like worried about it. You should know 20,000 to 100,000 penalties, and or go to jail for 6 months. You know, our jail so crowded one. Where got they will not send any taxpayer to jail one. Say only like in the act, they say they will send you to jail for 6 months. So it's always 20,000 to 100,000. But for exam purposes, you should know that there will be 6 months imprisonment, and or not necessarily must be sent. Okay, that's it. I think I finished. Let me look at questions. And question asked for. Let me see. Did I answer all the questions in the Q&A box? Nothing, is it? Regarding section 33.2 interest restriction, charge to statement of P&L, not more than 10,000 for company, not more than 6,000 for individual. Is this rule still applicable? Yes, still applicable. For the past year question, I realized only service tax question has been asked by examiner. Should we focus on service tax instead of sales tax? There was a question on sales tax. Sales tax, there's not so much to examine because there's not so much of exemption. So the service tax got more exemption. How to reduce your service tax is B2B, group relief, all those. So for the sales tax is only trying to get the certificate of exemption, maybe drawbacks, trying to get deduction. All those are important. Sales tax came out one time. Of course, most of it is on service tax. Okay, that's all. I think I answered all the questions in the Q&A box. So now, Chan, do we need to withholding tax? Yes, because the examiner has been setting withholding tax like every sitting, And I told you until she stopped setting in one sitting, then we know that it's not going to be a favorite topic anymore. Withholding tax, there's a lot of hoo-ha on withholding tax. All the current issues. What's the chance of PR being tested? Yes, there is a chance of the PR being tested. There are a lot of PR being updated and revised. You need to know all the revised stuff. I'm supposed to talk to you on RA, but I don't have time. I'm so sorry. So, okay, guys, good luck to all of you. For export incentive, minimum 60% capital owned by Malaysian. It means Malaysian citizen owned. It does not mean a company. It's a Malaysian citizen owned. So it has been clarified in MIA dialogue with the Inland Revenue Board. Okay, thank you very much, guys. Trust, I think, just came out not long. No need to focus so much. So I will pass the session back to Joanne. But guys, remember to do the quiz for me, okay? So good luck to all of you.
Thank you, Ms. Kok. I'll just probably let Raymond to say a few words then.
Okay, sure. Thank you, Joanne.
Thank you, Ms. Kok, for the very useful, insightful sharing session today. Hopefully, everyone can benefit from this and do their best in the upcoming ATX exam. And we wish you all the best in your exams. And of course, if you see Ms. Kok anywhere, please do say hi to her. And you want to buy her lunch, please do so. Yeah.
Okay, thanks, Raymond.
Yeah. Thank you, everyone, and all the best. Good luck.
Yeah, thanks, everyone. Good luck.
Yeah, good luck as well. Guys, you all have asked about the recording, right? Don't worry about the recording and also the notes that Ms. Kok has shared. I will send an email to you all whenever that's ready. Just be on the lookout for the email in the next few days, and most likely the latest is on Monday, but we will try our best to send this over the weekend, like tomorrow to you guys, tomorrow evening, or otherwise it will be on Monday midday like that. Okay. Yeah. So hopefully, in the near future, we're gonna have session like this, but definitely we won't want to see you again. We wish you to pass the exam, so you don't have to reattend it the second time or third time, but we will welcome the new students, taking this paper in the next future session. Yeah. Okay, you guys can leave the call already, can end the call. Yeah, thank you so much. Same to you, Jiayang. Have a great weekend as well. Hopefully the session benefits everyone. Yeah. Thank you. All right, guys, for those of you who are still in the webinar session, we have actually come to an end right now. So I will end the call, the webinar session. So all the best. Yeah, once again, good luck. Happy revision. Happy during the last minute studying revision, and try to capture what Ms. Kok has actually taught you all today. And yeah, good luck. Bye-bye.
All the best. Bye.
Yeah, bye-bye.